should be prepared in accordance with this particular standard, International Accounting Standard number 7. And actually, this particular standard requires that when a statement of cash flow is being prepared, the various activities which are undertaken by the company, basically to be classified into three categories. I hope you can be able to recall those particular three categories. Number one, we have the operating activities. Number two, we have the investing activities. And number three, we have the financing activity. So anytime you are preparing a statement of cash flows as an accountant, what you need to do basically is to appreciate the fact that the activities of the company should be classified into three categories. Operating activities. So what do you mean by the operating activities? These are basically the revenue generating activities, which are basically undertaken by a business entity. For example, a business entity may be providing services. A business entity may be selling goods to its customers for that business to be able to generate what? Revenue, or to generate what? Income. So therefore, operating activities, these are the revenue generating activities, e.g. provision of services, e.g. the sales of what? Of goods. Now, on the other hand, when we talk about now the investing activities, these are those particular activities which include acquiring assets and also selling or basically disposing what? Asset. And maybe for those who are doing AFR, and this also include acquiring a subsidiary and also disposing what? A subsidiary. And then we have the financing activities, and basically these are those particular activities which by the end of the day affect the size and the composition of the company's capital structure. So any activity undertaken by the company, it affects the capital structure of the company. That is the size and the composition is a financing activity, e.g. maybe the issue of shares, the issue of debentures, acquisition of bank loan, maybe the redemption of debentures which have been issued by the company, and so on. And then after classifying the activities into those three categories, in preparation of the statement of cash flows, we have to determine the net cash flows from each of these three activities, basically in that order. We determine the net cash flows of a company in that order. How do we determine this particular net cash flow? So to determine this, we take the cash inflow. Basically, when we talk about the cash inflow, this refers to any money which is flowing into the business. Like once the company sells an asset, the company receives money. Once the company issues shares or basically debentures, the company receives money. So the money which is received or money coming into the business, we basically refer to that as a cash inflow. The other rule is that when preparing the statement of cash flow, any amount which is a cash inflow, we record it in our statement of cash flow as a positive. As what? As a positive. So we take the cash inflows, and then to this we less the cash what? The cash outflows. So the cash outflows, basically, this refers to any cash which is flowing out of the business. And the rule is that anytime you are preparing a statement of cash flow and you come across an amount which is a cash outflow, then you record it as what? As a negative. So therefore, to determine these net cash flows, we take the cash inflows as positives, and then we less cash what? Cash outflows. Or basically, we deduct the cash what? Cash outflows. That's why we are saying cash outflows. We record them as what? As negative. So by the end of the day, we will be able to get the net cash flow from operating, investing, and also what? Financing. So maybe the other thing you need to remember very fast is that when preparing the statement of cash flows, basically we have two methods which can be used to prepare a statement of cash flows, or in other terms, to present a statement of cash flows. We have the direct method, and also we have the indirect method. And actually, the difference between those two methods, that is the direct method and also the indirect method. Indirect method is basically how we determine the net cash flow from operating activities. That is the only difference. How we determine the net cash flow from operating activities. That is actually the difference between these two methods. So under the direct method, basically, we determine the net cash flow from operating activities using a direct approach. Basically, we go to the cash book prepared by the company. Number one, we take into account the cash received from debtors or customers, which is basically a cash inflow. Then to that, we less the cash paid to the suppliers or creditors. We also less the cash paid for operating expenses. We also less the tax paid and the interest which was paid. We will be able to get the net cash flows from the operating activities. That is now using the direct method. Now, under the indirect method, we compute the net cash flows from operating activities using using an indirect approach. And actually, what we do under the indirect method, we take the profit before interest and tax, and usually we are deducted with three items: the non-cash items, which were added or deducted in arriving at that profit. Number two, the changes in working capital, basically where we consider 3 items of working capital: receivable, inventory, and payables. And also we adjust that profit with any investing or financing activity item which was added or deducted in arriving at net worth a profit. So basically, I think that is the first thing you need to remember as far as the statement of cash flows is what is concerned. And I think with that particular quick recap, I want us to go straight to a question. And there is a question which has already been shared in the class chat box, maybe for those who are joining us right now. So there is a question which has already been shared in the chat box. So if you can be able to see that question, please confirm that is the question you want us to do. Can you be able to see that question, those who are just joining? If you can be able to see that question, please confirm that is the question I want us to do. Can you see that question in the chat box? Can you see that question in the chat box? I want us to use the question from CPA Foundation level. CPA Foundation level. That is the question 4B of August 2024. Yes, so can someone reshare that question afresh? Evans, please reshare that question afresh. Reshare that question afresh. Reshare the question afresh. Yes, so I think it has already been reshared there. It has already been shared here. So let's go through it. We see what we are told and equally what the examiner was requiring here. So the question reads, part B, question 4B, it reads, the following are the financial statement of Precious Limited for the year which ended 31st of March 2023 and 31st of March 2024. So we are given Precious Limited statement of profit or loss, which is for the year which ended 31st of March 2024. We have the gross profit, operating expenses. We have other incomes which include interest income received, the gain on sale of investment, and then we have the loss on sale of plant. And then from there we have the interest paid, the interest expense which was paid, and then we have the net profit before tax. We have the income tax for that year, and then we have the net profit after tax. So then from there we have the statement of financial position. We are given statement of financial position basically for 2 years, 2023 and 2024. It is important for you to note that anytime you come across a question for cash flow, always the examiner will give you the statement of profit or loss for the current year. And then for the statement of financial position, that is basically the balance sheet, you'll be given the statement of financial position for the current year. For example, in a case, the current year is the year 2024, and for the previous year. So what you need to note is that the figures which are given here in the statement of financial position of the previous year, 2023, these are treated as the opening balances, whereas the figure we have here in the statement of financial position for 2024, those are closing balances. That's basically what you need to know. So we have the non-current assets, which include PPE, property, plant, and equipment, at cost and also accumulated depreciation. We have the investment, we have the current asset, which include inventory, account receivable, cash, prepayment, and then we have the total current asset and the total asset. And then we have liabilities and capital, where we have ordinary share capital, revenue reserve. Revenue reserve, this is another name for the retained profit, or is basically another name for the retained what? Earnings. Then from there, we have the long-term liabilities, which include both. We have the current liabilities, which include account payable, accrued liabilities. And then we have tax payable, and then we have the current liabilities, total equity and liabilities. Then we have additional information, number 1, all the way to note number 7. So what then are we required to do here? We are required to prepare a statement of cash flows, which is for the year which ended 31st of March 2024, in accordance with the International Accounting Standard number 7, which governs the preparation of the statement of cash flows. Now, in this case, number 1, recall what we have said. There are 2 methods which are used in preparation of cash flow. We have direct method, we have indirect method. But if you check on this particular question, the examiner has not specified which method we need to use, whether we use the direct method or basically whether we use what? We use the indirect method. But anytime you come across a question for cash flow, you are given the income statement or the statement of profit or loss, statement of financial position. If the examiner is not specific on which method to be used, always use the indirect method. So the indirect method basically has so many free months when it comes to computation of the cash flow from operating activities. So that is the first thing you need to do. The other thing, assuming these are questions you are doing in an examination setup, it is not advisable to start with the workings, because this where or what make majority of the students to fail in these particular questions. So how do you get free marks, or basically what you refer as the low-hanging fruit? So basically what you need to do is that once you come across a question for cash flow, number one, never start with the workings. Just go straight to what the examiner is requiring you to prepare, because the 16 marks which are allocated here, they are allocated for preparing a statement of cash flow. So if you do all the workings, they are correct. By the end of the day, you fail to prepare the statement of cash flow, you will get 0. So therefore, what you do, go straight to preparing what is required. Basically, any working which you do it per need basis. You are doing a working to determine an item to be posted in the statement of cash flow. So therefore, what we do, we go straight to preparing what is required. And actually, we need first of all to have the title. So the name of this company is Precious Limited. Precious Limited. And basically, this is the statement of cash flows. The statement of cash flows. And basically for the year, which ended 31st of March 2024. 31st of March 2024. Obviously, you must have the title. You must have the title of what you're preparing. And then from there, you need also to remember, in preparing this particular statement of cash flows, we have to determine net cash flow from 3 activities. So can you have those particular 3 subheadings? So basically, always, we start by determining the cash flows from operating activities. That's basically what we know. We start by determining the cash flows from operating activities. So here we need to have 2 columns, and I hope you can be able to see that if you go back to that question, all our figures are given. The figures in the income statement or the statement of profit or loss, the figures in the statement of financial position, they are given in thousands of shillings. So you need to have 2 columns here like that. So then from there, you leave some enough space here, because when computing the cash flow from operating activities, we have so many items which we record here. So leave enough space. And then from there, you have the other subheading for basically determining the cash flow from what? The cash flow from investing activities. And basically, remember, in this case, we have said investing activities are those activities which involve acquiring assets and also selling assets. So what we record here are the assets which were acquired, the assets which were purchased, and the assets which were sold. So we don't have so many items which we record here. Leave just enough space, not a big one. And then from there, we have the other subheading for determining the cash flow from the financing activities. And actually, all the items which we record here, we get them from equity and basically the non-current liability section of the statement of financial position. All the items which we record here, we get them from the balance sheet, specifically at the equity and non-current liabilities. And then down here, we come and we record something known as the cash and cash equivalent. This is cash and cash equivalent, a balance, a brought down, and also we record the cash and cash equivalent, a balance carried what? Balance carried down. Balance carried what? Balance carried down. That's the first thing you need to have anytime you come across this particular question for what? For cash flow. Anytime you come across this particular question for cash flow. And then having that now, I want we proceed and we look on how then do you get the low-hanging fruits. So there are the low-hanging fruits. Remember, we have said that these are the free marks. These are the marks basically you get without any working, without any what? Any working. So basically, the first thing I advise my student to record is this: cash and cash equivalent at the start and also at the end of the year. So what do you mean by cash? Cash, basically, you can be able to recall, this is cash in hand, a cash at bank overdraft, and then cash equivalent. These are the short-term investments. The short-term what? Investments. So basically what we need to do is we go to our statement of financial position under the current assets. We check whether we have cash in hand, cash at bank, short-term investment, and then still we will go to where we have current liabilities. We check whether we have a bank overdraft. So can we do that? The first thing, we go to the statement of financial position, specifically under the current asset. So under the current asset, can you tell me which item of cash and cash equivalent do we have there? Which item of cash and cash equivalent do we have under the current assets? So tell me which item of cash and cash equivalent we have there. Which item of cash and cash equivalent do we have? Do we have under the current assets? Type it in the chat box. Yes, I'm told the first one is basically cash. Is actually what? Cash. You also check, do we have bank balance? No, we don't have bank balance. Do we have any short-term investment there? No. So therefore, and remember what we have said, that we are given statement of financial position for 2 years, 2023, 2024. So the balances we have here, these are opening balances. In other terms, these are what we refer to as the brought down. The brought what? Down. Whatever we have here, these are closing balances. This is what we refer to as the current what? Down. That is also very, very important. Very, very important. So therefore, what we have is cash. So what we do, we take cash, and basically the cash, we take cash at the start from the statement of financial position for 2023, and I hope you can see that is a figure of 2250. And then from there, we go to where we have the current liabilities. We check, do we have a bank overdraft? So under the current liabilities, do we have a bank overdraft? Yes or no? Do we have a bank overdraft? Yes or no? Under the current liabilities. Do we have a bank overdraft? No. So but if we had a bank overdraft is basically money which is owed to the bank. We come and we raise it here. So therefore, the cash and cash equivalent at the stand is how much? Is 2250. So we do the same. We do the same at the end of the year. So by now we know that we only have one component of cash and cash equivalent, and that is basically cash. So what we will do, we will take the cash and cash, the cash balance at the end of the year, and basically that is an amount of how much? That is an amount of 69. That is an amount of what? Of 69. Yes, someone can, someone to share that question, in the chat box. Someone to share that question in the chat box. Someone to share that question in the chat box, please. Someone to share that question. Someone to share that question in the chat box. Okay, it has already been shared, Janet. There, I hope you have seen it. Yes, so that is the first thing you record. And in most of the cases, what is important for you to note, what is marked in these particular questions are the entries. Are what? The entries. And basically, mostly this particular question for cash flows, how are they marked? This is how these particular questions are marked. So like you can see the marks are located here were 16. So mostly these particular questions will be marked like this. Any 8 correct items here, you are given 2 marks. So mean that if you get 8 correct entries here, you'll get 16. Alternatively, if the question has so many entries, the question can be marked like this. Any 16 entries at 1 mark, and basically you get what? The 16 mark. So it depends with the number of entries. So if a question do not have so many entries, it can be like marked like that. If the question has so many entries, it will be marked like that. So therefore, what is important here is not by the end of the day to do so many workings here. What is important when preparing a statement of cash flow are the correct entries you make here. Are the correct entries you make what? In the statement of cash flow. For example, those 2 correct entries, those 2 entries, they are correct. Those are already 2 ticks. Yes, after doing that, then we come back here to where we compute the statement of, or actually we compute the cash flows from operating activities. And remember, in this case, I've said here, we are preparing this particular statement of cash flows using the indirect method. So under the indirect method, we compute these particular cash flows by starting here, or here we start with the profit before what? Before tax. When computing this, we start with the profit before tax. Where do we get the profit from before tax? We get this from the income statement. Can we go to the income statement? You give me the profit before tax. How much is the profit before tax from the income statement? How much is the profit before tax from the income statement? So in our case, it is referred as net profit before tax. Net profit before tax. Can you see that one? Net profit before tax? Yes. So the net profit before tax is basically an amount of 450. But if you can be able to recall, we said in computing this particular cash flow from operating activities, we should start with the profit before interest and tax. In other terms, what is known as the operating profit. But if you check, in our case, we don't have that operating profit. So therefore, what we say is that to this particular profit here, the first adjustment which we make, or the first adjustment to this profit, is basically to add back the finance cost, which is also known as the interest expense. The interest expense. And actually, this interest expense is always above that profit. Is always above that profit. So can you see that figure of the interest expense? Yes, the interest expense is the same. That is an amount of what? 3450. And actually now that will give us the profit before interest and tax. And then from there we say to this particular profit, we need to make a number of adjustments. The first adjustment we make to this profit is basically to adjust it with the non-cash items. We say the non-cash item, for you to be able to remember the non-cash item to be adjusted to this profit, just remember that acronym. The acronym is 𝐷𝐿G. 𝐷𝐿G. So this stands for what? This stands for depreciation. This stands for depreciation on property, plant, and equipment. This one stands for impairment loss. Impairment loss on goodwill. Impairment loss on goodwill. A stands for amortization. Amortization of intangible assets. Amortization of intangible assets. Then this one stands for loss on disposal. Loss on disposal. So the loss on disposal is basically whereby the company disposed or sold some assets during the current year, and basically the asset was sold at a loss. They were sold at what? At a loss. And this one is basically stands for gain on disposal. This one stands for gain on what? On disposal. So therefore, what we need to do, we need to go to the additional information. But I think even before you go to the additional information, because most of these items will be given in the additional information, on the face of the income statement, there are a number of items we need to adjust to these. We need to adjust to this profit. So can we go back to the income statement or the statement of profit or loss, and specifically whereby we are given other incomes? Specifically whereby we are given other incomes. So where we are given other incomes, number one, we are given something called the interest income received. Now, interest income received, is that an income from operation? That is the first thing you need to ask yourself, because what we want to determine here is the cash which was generated from operating activities. Now, anytime you're given an interest received, a company receives interest as a result of having invested. So therefore, what you do, because that interest has already been included here, you come here and you less it. So first of all, we can skip all these items, and then we take the interest which was received, interest income which was received, interest income which was received, which has already been added in this profit. So the reason why we are raising this is because this is not an income from operation. So this is an income generated by the company from what? Investing. So you raise it from that profit, and then you come and include it here. So that is the interest income which was received. And remember, this is money which was received. So when recording it here, you record it as a positive. So why are you recording it there as a positive? It is because it is cash which was received, is an inflow. But here we're recording it as a negative. Why? Because we want to eliminate it here from this profit. It is included there, but it's not income from operating activity. So you less it here, and then you bring it there. That is the first item. Then still under the other income, we have the gain on sale of investment. So the gain on the sale of investment. So anytime the company sells an asset, be it an item of PPE, and that item is sold at a gain, so that gain is usually accounted for as an income, but basically we say that is a non-cash item. That is a non-cash item. So take into account it is included there. What do you do? Place it down there. Then also below that, the gain on the sale of investment, we have the loss on sale. We have this. So the loss. So the loss, basically is 450. You can see the loss in arriving at this particular profit, it has been deducted. It was accounted for as an expense. So, and because this is a non-cash item, what we need to do, we need to add it back. Actually, these non-cash items, basically which we have here, depreciation, impairment loss, amortization, and the loss on disposal, because in arriving at this profit, they had been deducted. What you do, you add them back. But now this gain, you do what? You less it. That's basically what you need to remember. Yes. So you can see that all these are free marks. All these are free marks. This is basically what we refer to as low-hanging fruits. These are basically marks which you're able to get in this particular question without any struggle. Without any what? A struggle. You can see so far we have not done any working, but we have so many entries here. Yes. Now, having said, I think we need to go to the additional information because we don't have anything else we can be able to pick from the statement of profit or loss. Let's go to the income statement. Not the income statement, in the additional information. In the additional information number 1, we are told Precious Limited purchased investment worth 11.7 million during the current year. So this company purchased investment. So if a company purchased investment, remember, is a form of an asset. And that's why if we go back to our statement of financial position, specifically where we have the non-current asset, you'll be able to see we have the property, plant, and equipment. We have accumulated depreciation. Below that, we have investment. So we have said those particular activities which involve acquiring and disposing assets, they are what? Investing activities. So that purchase of investment, you come and you record it here. Purchase of what? Purchase of investment. Purchase of investment. So the investment which were purchased were 11.7. And I hope you can be able to remember, in all the figures we are given in the income statement of financial position, the last 3 zeros are omitted. So anytime you're taking a figure from the additional information, you must do the same, omit the last 3 zeros. Then you also need to remember our rule here. When preparing the statement of cash flows, we have said this rule is very, very important. This rule is very, very important, that any amount which is a cash inflow, we record it here as a positive. Any amount which is a cash outflow, we record it in our statement of cash flow as what? As a negative. So now who can tell us this particular amount here? Once the company purchased an investment, is that an inflow? That particular amount there, is it an inflow or outflow? The company purchased an asset. Is that an inflow or basically outflow? Inflow or outflow? Who can tell us? Inflow or outflow? Yes, automatically this one is outflow. This one is what? Is outflow. So take into account as an outflow, we record it here as a negative. Don't forget, if you record it here as a positive figure, it is wrong because the person is marking will only give you mark if it is recorded as an outflow. We are done with that. Let's move to note number 2. We are told the company sold a new investment that had cost 13.5 for 15.3 million. So we have sale of investment. So remember what we consider here is asset which were acquired, asset which was sold. So in that case, we can say there was sale of investment. There was sale of investment. And basically, once the company sells an asset, what do we consider here? What do we consider here is the proceeds. When we talk about the proceeds, this is the money you receive after selling an asset. If you sell an asset, how much cash do you receive? So in that case, we are told in note 2, that investment had a cost of 13.5. It was sold for 15.3. How much cash was received in that case? Is it 13.5? Is it 15.3? How much cash was received? You can tell us here. The cash inflow, the sales proceeds, that basically what we consider here. Yes, I'm told by Evans that the cash received here is 15.3. 15.3 units. Yes, that is very much correct. 15.3. And then 15.3, this is an inflow. When you sell an asset, you receive money. You sell an asset, you receive what? You receive money. You receive money. Yes. So basically, that is it. That's what we need to recognize there. So we are done with that. Let's move to note number 3. We are told during the year, a new machinery worth 18 million was acquired. Was what? Acquired. That is also another free entry here. So the company acquired a machine. So once the company acquired a machine, that is still an investing activity. So we say there was acquisition of what? Of a machine. There was acquisition of a machine. You can see the number of entries we have in our statement of cash flows, yet we have not done any working. Have we done any working, Kelvin, here? Have we done any working, Eunice? Have we done any working, Evans? we have not done it. And you can see the number of entries which we have. So because I've said what is marked in these particular questions are these entries. This is basically what we refer to as the low-hanging fruits. This basically marks you get without a lot of struggle. So and then you are told in the same point number 3, sentence 2, some item of property, plant and equipment had a cost of 1.5 and accumulated depreciation of 300,000 were disposed for 750. So many free marks here. So we have disposal. Disposal, remember, is the same with the sale. Is the same with the sale of an item of PPE. What do we consider here? What we consider here is the proceeds. So that item of PPE which was disposed, we are told it was disposed for how much? Can you see the sales proceeds here? So that item which was disposed, was it disposed at 1.5, 300 or 750,000? It was disposed for how much? What is the sales proceeds? That is basically what we consider here. Yes, the amount which you consider here is 750. The sales what? The sales proceeds. So basically we are done with that point. Let's move to point number 3. Point number 4. We are told included in the operating expenses for the year which ended 31st of March 2024 is depreciation charged, and the depreciation charge for the year which amounted to 5,550,000. So in our case, we come back here, we're given this depreciation, which is 5,550,000. That is another free entry. So, and we said that this is a non-cash item. It was deducted in this profit, we add it back. That's why we say this part, these 4 items there, we add them to the profit. So we are done with that. So we move to point number 5. We are told the company issued bonds worth 15 million at a face value in exchange of a current asset on 31st of March 2024 and repaid bonds worth 7.5 at the face value, at the face what value. Now in that case, we are given 2 transactions in one point. One, we are told the company issued bonds. Bonds are basically the same with the debentures. So bonds are the same with the debentures. So means that if you go to the balance sheet, to the statement of financial position and the non-current liabilities, you should be able to see bonds there. And I hope you can see that in our statement of financial position and the non-current liabilities, we have both. Bonds are basically the same with debentures. We are told that there were some bonds which had a value of 15 million, which were issued in exchange of a current. Let me first of all ask, is this, or do we have any movement of cash there? The moment the company issued bonds in exchange of an asset, do we have any inflow or outflow to the company? Do we have money flowing in or money flowing out? You issue bonds, you receive an asset. You issue bonds, you receive an asset. Is there any movement of cash there? There is no movement of cash. So therefore, what is important to note is that when preparing a statement of cash flow, actually from our definition, I said, it is prepared to show the sources of cash and the application of that cash. How was the cash generated by the company utilized? So therefore, in preparing a statement of cash flow, any transaction which does not involve movement of cash, any transaction which does not give rise to cash outflow or cash inflow, we don't consider it here. Sasa, yes, like that transaction will not be considered here. It's a non-cash item. But also on the same point, you are told the company repaid bonds. So when talk about repaying bonds, you see bonds are issued by the company for the company to borrow money. So the company usually will have agreed with those who will buy bonds that they will be given back their money after a number of years. For example, the company can issue bonds having a life of 5 years. So meaning that the holders of the bond will be given back their money. In other terms, the company will pay back those particular bonds at the end of the 5th year. So once the company repays bonds, that is a cash outflow. And where do we consider that? We consider that here. That's why we said all the items which you record here, we get them from equity, non-current liabilities. We know both are part of the non-current liabilities. So here we will come and we say there was a repayment of bonds. There was a repayment of bonds, basically which had a value of 7.5. And this is cash outflow. The moment the company repay back the bonds, which had been issued, that involve cash outflow. So we are done with that point. So let's move to point number 6. And you're told the company issued 2.25 million ordinary shares of shillings 10 per, basically per value. So where do we consider this? This one is considered here. And basically, can you go to where we have, because that basically affected the share capital, let's go to where we have share capital. share capital. And basically in that case, you can see the share capital increased because remember in our case, we are given a statement of financial position for 2023. I've said these are opening balances, and 2024 basically, which you have said are closing balances. So you can see the ordinary share capital at the start was 47 to 50, and then at the end of the year, the share capital increased. So the reason why we have an increase in share capital is because the company issued shares. So who can tell us how much is the increase here? The increase is how much? The increase, that increase in share capital is, I'm told by Evans, is 22,500. So basically, as per point number 6, we are told this increase was due to issue of how many shares? The company issued 2250 ordinary shares, each share having a value of 10. So if you multiply this, the value of each share with this one, you'll see that will automatically give us that amount. So when the company issues shares, that one is considered here is a financing activity. The company issue a share to do what? To raise finances. So we say there was issue of ordinary shares. So how much amount was received? 22,500. So the amount received by the company is a cash what? Inflow. So we consider that here. Yes, we consider that there. So then outflow recorded here as a negative. Recorded there as what? As a negative. Are we done with the notes? Yes. Can you see the number of entries we have here? Even if, for example, the question was marked like this, because this one automatically, you can see it has so many entries. So automatically, for every 16 ticks, 16 correct entries, you get a mark for each. And basically, by the end of the day, you get how many marks? 16. Can you see the number of entries we have? Basically, we have not done any working, but you can see the number of entries we have. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. If you decide to read that question like that, you'll be having all the marks. And basically, that's a question which you should be able to do within not even more than 30 minutes. Because the other thing, maybe for those who are doing the CASNEB exam for the first time, so you'll come across a question with 5 marks. 5 questions. You're given 3 hours. So if you take 3 hours times 60, that basically comes to a total of 180 minutes. 180 minutes. So this basically to handle how many questions? 5. So if you take 180, you divide with 5, basically this will give you 36. So it basically means that this question should not take more than 36 minutes. More than 36 minutes. That's why it's basically important for you to know the approach to use, so be able to know how to harvest the low-hanging fruits, how to get the free marks. The free what? The free marks. Now, after doing that, there are other free marks here you should always get. You should get down here. And basically that is in relation to the changes in working capital. These are also free marks. Changes in working capital. Now, here, remember we consider majorly 3 items. And for you to be able to remember the items we consider here, just recall that acronym. Just recall that word. Just recall this acronym here. RIP, receivables, inventory, and what? And payables. That is basically what we written for you will be taking. Did you prepare the statement of cash flow? And now, if you prepare this, he will come and check these correct entries. So that's where the marks are. Never start with workings. Those workings, by the end of the day, they do not earn you any marks. They just consume a lot of your time. And I've said any working you are doing here, do it per need basis. You are computing an item to be posted here. Don't compute something which is not required to be posted here. Do all the workings per need basis. Because knowing that approach, Juma, is very, very important. It will save you a lot. It will save you a lot. Yes. Let's come back here now. I want us to still do another question like this. So here we consider 3 items: receivable, inventory, and payables. So receivables, inventory, and payables. But basically I've said, remember this acronym. Not less in piece, but this one stands for the receivables, inventory, and what? And payables. Now, what we need to do basically here is to do what? Is to determine whether there was an increase or decrease. as far as these three items are concerned. Now, to make it very simple, here there is a formula I give my students. So here we take this. I'll be able to explain what you mean by that. O minus C. And then here C minus O. Yes. So just remember that. O minus C, O minus C, C minus O. So what is this? This is opening balance minus closing. Opening balance minus closing. Closing balance minus opening. So you apply that formula. Whatever you get by applying that formula, if it is a negative, you record it as a negative. Whatever you get by applying that formula, if it is a positive, record it as what? As a positive. Sasa? Yes. So we start with we go to where we have our statement of financial position under the current asset. We know inventory and receivables is part of the current asset. So can we start with the first item? And that is the inventory. So we will take the opening, which is 16.5 minus the closing. Opening minus closing. 16.5, which is the opening, minus closing, which is 21.6. 21.6. What do we get? What are we getting here, Eunice? Yes, we are getting negative 51. So record it as a negative. That is an outflow. That is what? An outflow. And basically that is inventory. That is what? Inventory. That is the inventory. That is the inventory. And then from there, we do the same. We do the same for receivables. Receivables, we do the same. Opening minus closing, 82.50 minus 70.50. So we get positive what? Positive 21. Positive 21. So we have that. But now, before we move to receivables, sorry, to payables, I hope you can also be able to see under the current asset. Below cash, can you see we have prepayments? Can you see we have prepayments? Yes. Now, prepayment is basically part of receivables. It's part of what? Receivables. So in case under the current asset, in most of the cases, will be given the account receivables, and other receivables. If you're not given other receivables, the examiner will give you prepayments. Other receivables can also be known as what? Prepayments. So what we consider here is the trade or the account receivables and other receivables. So in case you're given prepayment, also you have to consider that here. Are we together? Yes, because this is one of the items most of the students will not consider here. So prepayment, basically, I've said, is the same with other receivables. We are going to use the same formula. Opening minus closing, because the same with the receivables. So can you do that? Opening minus closing. Opening minus closing, what are you getting? That is giving us negative, Negative 600, Negative 600. Yes, I'm waiting for the answer. I'm not getting the answer fair. Please give me the answer. I'm saying under the current asset we have, below cash we have prepayments. Below cash we have prepayments. We have prepayments. It is positive, Yeah, it is positive. Okay. So then we got where we have current liabilities. We consider payables. Current liabilities, payables. For payables, we use this formula, closing minus opening. Closing, which is 75, minus opening, 64.50. 64.50. So which is giving us what? Which is giving us 10.50. Are you getting 10.50? I'm not getting the answers here. I'm not getting answers. Juma, give me the answers. Eunice, Paul, give me the answers here. Give me the answers. Hussein, Felix, I'm waiting for the answers. Zipporah, give Morimu the answers here. Give me the Morimu the answers. Okay, yes, that's basically what we have. It is also important here also under the current liabilities, just like what I've said under the current assets, under the current liabilities, you also need to check whether you are given something like accrued expenses or maybe accruals. So what else do we have there? We have, yes, there is something also we are going to consider here, and that is accrued liabilities. Now, the accrued liabilities, that one is the same with the accruals. So, yes, other than considering the payables, you also consider other payables. Other payables can be accruals or maybe accrued expenses. So we also consider that here, and that is the accrued liabilities. Accrued liabilities. Accrued liabilities, we use the same formula here, this one, closing minus opening. Closing minus opening, closing 18 minus 1350, which will give us what? 450. 450, is that what you're getting? 450? Yes, 450, which is basically a positive. That's what we consider there. Then I think we're almost done. Two other items which are also important here. Number one is the tax paid. The tax paid, and number two, the interest or the finance cost which was paid. Now, for the tax which was paid, this one we need to do some working. So which is not complex, because what we consider are two items. One, if we go to the income statement, we have the income tax expense for the current year, which is 1050. And then if we go to where we have current liabilities, we have tax payable. So how do we compute the tax which was paid? To compute the tax which was paid during the current year, I want you to be very keen. We take the accrued tax at the start. At the current liabilities in the balance sheet, how much tax was payable at the start of the year? The tax payable at the start of the year was how much? Was 750. So this is the tax the company was supposed to pay during at the start. And then to that, we add the tax which was payable during the current year from the income statement. From the income statement, our company was supposed to pay a tax of 1050. So this is the total tax the company was supposed to pay during this year. And then the tax which are not being paid at the end. The tax which are not being paid at the end is what we have in the balance sheet under the current liabilities, and the tax which are not being paid was 450. It basically means that the difference here is the tax which was paid. So this will give us tax paid of how much? I've taken the tax the company was supposed to pay at the start, the tax the company was supposed to pay during the current year, and then I've deducted what are not being paid at the start. And basically that will give us what? 1350. And then for the interest which was paid, this one I think is quite straightforward. You consider two items, the interest expense in the income statement, which was this one, and still you go to where we have current liabilities, you check, do we have any accrued interest? In case we have accrued interest under the current liabilities, you use the same approach we have used for tax there. You should take the accrued interest at the start plus the interest in the income statement, this one, minus the accrued interest at the end, which basically give us what? 3450. That is basically the tax which was paid. Not the tax, rather, the interest which was paid. And in our case, we are done. That question, don't even bother trying to add anything. Don't bother adding anything. The person who is marking your paper will be interested with these entries which we have here. He will be interested with these entries. So he will mark these entries. These what? These entries which are here. These entries which are here. These are the entries which will earn you the marks like that. Not even the workings. Not even the workings. So that is basically what will be marked. And therefore, as you practice, can you try to use this particular approach here? This basically will save you. This will do what? Will save you in an exam. This will save you in what? In an exam. I want us to do another question. For cash flow. Another question for cash flow. For cash flow, we can pick another one, just a random one. I want us to go to the question for August 2023. August 2023, still from CPA foundation level. CPA foundation level. Yes, and maybe for those who are joining the class, our class here for the first time, who are not part of our students. So our block revision actually started today. This should be our first class for revision for financial accounting, and yes, financial accounting. So if you know of a colleague who is basically preparing for August 2025 exam, is not well prepared, you can basically talk to him or her to join us, to join our revision. Right now we have an early bird discount. Basically, if a person pay for our blocks, we are just charging as low as 1,500 per word per unit. So basically, this will help you in terms of accessing our revision for the next 4 weeks. So our revision classes will take place from today, which is basically is 21st of August up to 16th. This is the 21st of July up to 16th of August. So basically, this will be a 4-week marathon for revision classes. So if you know someone who is preparing for this exam, the August exam, is not well prepared, or maybe he wants to prepare, so you can talk to him or her basically to join our revision classes. I've said we are charging 1,500 for all the units, but maybe for those who are doing BDA, Business Data Analytics, this is an exit paper in CPA. For that paper, we are charging 2,000. That is an early bird discount. It will expire tomorrow. So if you take the advantage of the discount, basically that will be better. So from tomorrow, the amount now will go up with 500. So that question has already been shared here by Evans. August 2023, which is question number 4. August 2023. Question what? Question number 4. So what are we told here? The question reads, we are told the following information was extracted from the financial statements of Biashara Limited for the year which ended 30th of June 2023, 30th of June 2023, 30th of June 2023. So we are given the statement of financial positions here. That is the statement of profit or loss for the year which ended 30th of June 2023. And then we have the statement of financial position for 2023 and basically 2024. So in that case, we have said 2022, the figures given there are opening balances. 2023 and the closing what? The closing balances. The closing what? The closing balances. The closing balances. So we have basically that statement of financial position. We have the additional information, number 1, all the way to note number 5. So what are we required to do here? We are required to prepare the statement of cash flows for the year which ended 30th of June 2023 in accordance with IAS 7. Is the method to be used specified? No. But I've said if you come across a question for cash flow and you're given the income statement of financial position, always use the indirect method. So and then from there, we're required to comment on how Biashara Limited has generated and used its cash and cash equivalent for the year. So you can only be able to comment on that after preparing the statement of work of cash flows. After preparing the statement of cash flow. So we have said never start with the workings, just go straight to what is required by the examiner. So the name of this company is Biashara Limited, and this is the statement of cash flows. The statement of cash flows, which is basically for the year which ended 30th of June 2023, 30th of June 2023. 2023. So here we start by determining the cash flow from operating activities. Cash flow from operating activities. We need to have 2 columns here. And I hope you can also be able to see our figures there are given in thousands of shillings like this. Are given in thousands of shillings. Are given in thousands of shillings. Yes, so we have said we leave enough space here. Then we have the other subheading for computing the cash flow from investing activities. And I hope you can be able to recall investing activities. These are activities involving acquiring and disposing assets. And then we have the other subheading for determining the cash flow from the financing activities. Remember, I've said all the items which we record here, we get them from equity, non-current liability section. And then down here, we come and we record the cash and cash equivalents, cash and cash equivalents at the start, and the cash and cash equivalents balance carried down, So that is the first thing you need to have there. That is the first thing you need to have. So if you have that, I want us to now move together. We prepare this together. So do you have that format with you? If you have that format with you, I think we can move together. Do you have that format? Do you have that format with you? If yes, type that in the chat box. Yes. So we have said we always start by recording what? The cash and cash equivalent at the start and also at the end. So can we do that? We go to where we have the current assets. In the statement of financial position, we determine how much was the cash and cash equivalent at the start and also at the end. I've said we consider a number of items: cash in hand, cash at bank, short-term investment. We go to where we have current liabilities. We see whether we have a bank overdraft. So under the current assets, so I can see we have short-term investment. That is the first thing we need to consider here, short-term investment. The short-term investment at the start. Remember, 2023 is the current year. These are the closing balances. 2022, these are opening balances. That is very important. So the short-term investment at the start is 50/40. So below that, we have cash in hand, which is 25/80. And then we go to where we have current liabilities down there. We check, do we have a bank overdraft? Yes or no? Yes, I can see we have a bank overdraft. The bank overdraft at the start, which is 2022, is 39,240. And in this case, I've said a bank overdraft. We take it here as a negative. We take it here as what? As a negative, because this is money which is owed to the bank. We get the net amount. That will give us a net amount of what? We have 50/40 plus 25/80 minus the overdraft, 39,240. What are you getting here? I'm getting negative 31,620. Is that what you're getting? Yes. And that one is a negative. We do the same at the end of the year. So at the end of the year, we will take the short-term investment, which is basically 10 to 60. And then we take the cash in hand, which is basically 12. And then we less the overdraft, which is 14,340. We get the net, and that is the cash and cash equivalent at the end. So 10 to 60 plus 12 minus 14,340. And that will give us negative what? Negative 28,810. Negative 28,810. We already have two entries which are correct. Then we come back here and we start by recording a cash. That is not cash, rather the profit before what? The profit before tax. What is the profit before tax from the income statement? The profit before tax from the income statement, I hope you can see that, is a figure of 14,400. I hope you can see that. Then we make a number of adjustments to this profit. And the first adjustment we make to our profit, we said, is to add back the finance cost, or basically to add backward the interest. That is the first thing you need to remember, which is basically just above this. So, and I hope you can see that figure there, which is 25. Sasa, we add it back. Such that now we have what? We have the profit before interest and what? And tax. Then we have said to this, we need to, or we adjust that profit with the non-cash items. We just need to remember this acronym, the dial G. This stands for depreciation on property, plant, and equipment, PPE. This one stands for impairment loss. Impairment loss on goodwill. And basically, this one stands for amortization. Amortization of intangible asset. Amortization of intangible asset is the decrease in value of intangible assets. And then this is loss on disposal. Loss on disposal. And then this one is the gain on what? On disposal. So we have said these past 4 items. This one, we add them to the profit, but this one we do what? We less. So on the face of the income statement, do we have any of those items on the face? Like the other question. On the face of the income statement, we don't have any of these items, but I can see investment income. Can you see the investment income? Yes. Investment income, basically, this is an income generated by the company from investment. So it is already included here. What we will do, we will less it from that profit. Why are we lessing it here? Is because it's not an income generated from operation. Generated from operation. So we less it here, then bring it here. And basically, therefore, what you need to note from the other question which you have done, interest income received is the same with the investment income. Investment income is the same with what? Interest received. That's that? Yes. So you bring that here. It's an amount of how much? 15. So then from there, we don't have anything on the face of the income statement. Can we go to the additional information? Let's go to the additional information. In the additional information number 1, we are told the revaluation reserve relates to freehold land. So if you're given told revaluation reserve, these are components of equity. If you go to the balance sheet and the equity, you should be able to see that. But it's also important for you to note that if there was some asset, for example, which were revalued upward or downward, we don't consider that here because that is an non-cash item. So we are not even concerned with that. Let's go to note number 2. We are told depreciation on plant and machinery amounted to 6.9. Amounting to 6.9 was charged to the statement of profit or loss. In that case, we are given depreciation of 69. And remember, when taking any figure from the additional information, remember to omit the last 3 zeros because you can see our figures are in thousands. So we add it to this profit. Number 3, part of the long-term investment was sold during the year at a profit of 960. So in this case, we are told part of the investment was sold at a profit. We are only given the profit in this case. We are not given the sales profit. So what do we record here? 1, we will record that sale of investment. Sale of investment. But remember, I've said what we record here are the proceeds. So how much amount was received from the sale of this investment? Are we given that? No. But what we are given is this. We are told there was a profit. A profit is the same with a gain. A profit on sale is the same with a gain. So the profit on the sale is the same with a gain. So there was a gain in this case of how much? Over 960. So that gain, this one we less it from that profit. But even before we move to the other point, number 4, can we be able to know this investment which was sold? It was sold for an amount of how much? Can we go back to where we have non-current assets? Non-current assets. Non-current asset. How many assets do we have there? We have 3. Freehold land, plant and machinery, investment. Automatically, because investment was sold, the value for investment reduced. Can you see that? The investment at the start had a value of 22.5, and then that reduced to 21.6. Can you give me the reduction? Give me that reduction in the value for the investment. And then I will be able to explain how do we compute the sales profit. How do we compute the sales profit? So the value for investment reduced with what? The value for the investment reduced with what? The value for investment reduced with what? The value for investment reduced with 900. It basically means that this investment which was sold had a value of 900. They had a value of 900. The company sold the investment having a value of 900. This is the value for the investment. But by the end of the day, we are told the company made a profit of 960. So that is the profit, made the profit of 960, made the profit of 960. So in this case, can we be able to know our investment was sold at how much? If you have an asset having a value of 2 million, and then you sell it to make a profit of 1 million, you sold that asset at an amount of how much? You have an asset having a value of 2 million, but you sold it, you made a profit of 1 million. So you sold that asset at an amount of how much? That asset was sold at how much? Very simple. If you have an asset having a value of 2 million, you sell it to make a profit of 1 million. Automatically, you sell it at 3 million. The same concept you're using here. So this investment was sold at its value, 900, plus the profit. So this one was sold at 18.60. So that is a cash inflow because this money received from the sale of the investment. So let's go to note number 4. We are told during the year, the plant with a net book value of 4.5 was sold for 8,820,000, and then you're told it had an original cost of 18. So what we are interested with here is the amount which was received from the sale. Remember, anytime the company sell an asset, you consider here. We say there was a disposal. Disposal is the same with the sale of a plant. What do we consider here? We consider the proceeds. It was sold at how much? It was sold for 8,820,000. So that is the what? That is the proceeds. That is sales proceeds. Also, if you can be able to recall, we say that anytime the company sell an asset, you have to determine, was the asset sold at a gain or at a loss? So we said, if you can be able to remember, my student for FA, we said you need to prepare a disposal account, though it's not a must. Once the company sell an asset, for you to determine whether it was sold at a profit or at a loss, just take the sales proceeds. Just take the sales proceeds. The asset was sold at an amount of how much? You less the net book value, which is also known as the carrying amount. In that case, we know that item was sold at 8,820. I hope you can be able to see up there, minus its net book value. We are not given the net book value, but basically, yes, we are given the net book value actually. The net book value is given, which is 4.5. 4.5. So you can see automatically that asset was sold at a profit. Because we said by applying this formula, if you get a positive figure is a profit or a gain. If you get a negative figure is a loss. Is a loss. So how much is the profit here? The profit in other terms known as the gain. The profit or the gain is how much? 8,820 minus 45. Yes, we have a profit of 43.20. So this is a profit, or in other terms, is a gain on the sale. Is a profit or is a gain on the sale of a plant. Now, that should also be captured here because you can see the company sold 2 assets. There was what? There was gain on both. So that gain. So remember, this is a gain on sale of investment, and then we have gain on sale of plant. So the gain on sale of plant is 43.20. We also less it from our profit because in arriving at this profit, it was added, but it's a non-cash item. It's a non-cash item. So we are done with that point. Let's move to point number 5. We are told the following balances were extracted from the statement of changes in equity for the year which ended 30th of June 2023. So this is basically the change in the retained earnings. So we're given the retained earnings at the start, the profit after tax, the interim dividends which were paid, the final dividends which were proposed, and the balance. Now, from that information, what we are going to consider here is basically the interim dividends which were paid. If the company pays some dividends, and basically talk about the interim dividends, these are the dividends paid by the company in the middle of the financial year. If the year starts January, end in June, maybe the company in course of that year paid some dividends. That's basically what we consider here. So the dividends which were paid. That is basically 900. The dividends which were paid, the interim, but you can see we have other dividends which were proposed to be paid. So the proposed dividends were not yet paid. They were 27. But I think you have now to compute the final dividends which were paid. The final dividends which were paid. So how are we going to compute these final dividends which were paid? We are going to use the same concept, which I've explained in the other question, for computing the tax paid or for computing the interest paid. Now, if we go to where we have current liabilities, can we go to where we have current liabilities? Current liabilities. At the current liabilities, you'll be able to see proposed dividends at the start, at the end, in the balance sheet, at the current liabilities. So we are going to use the same concept we have used in the other question. In the other question. So yes, thank you for that. I'm told it is not that figure Morimo is speaking here. No, I hope maybe you're asking about this one. I hope you're asking about this one. Are you asking about this figure? Yeah, the gain? Yes, the gain should be a negative. And this one should be deducted from our profit. I hope you did the same for this. Any gain on the sale of assets has to be deducted from this. Because this one is already added here, but basically is a non-cash item. We do what? We less it. Sasa? Yes. Now let's come back here and we compute the final dividends which were paid. I'm saying we are going to use the same concept we have used in computing tax paid, interest paid. So what we do at the current liabilities, we will take the dividends which were proposed at the start, that is the year 2022, and they were 22.80. These are the proposed dividends the company was supposed to pay at the start. And then we add the proposed dividend for the current year, which we have in note number 5. The proposed dividend for the current year, they have a value of 27. So this will give us the total dividend the company was supposed to pay during the current year. And then we less the dividends which were not yet paid at the end. The dividends not yet paid at the end, you can see they have a value of 27. So can we be able to determine the dividends which were paid? Yes. So it will basically be this one. 22 what? 22.80. We record it as a negative. So, and I think we are done with the notes. Having finished with the notes, then we come down here and we consider what? The changes in working capital. Never forget to get these 3 marks. Changes in working what? Capital. Because here we have said these are just 3 marks. These are just 3 what? 3 months. So here we just need to recall the acronym, that is RIP, not less in peace, but receivables, inventory, and payables. The receivables, inventory, and what? And payables. So how do we deal with these 3 items? We just need to determine whether there was an increase or decrease. And then we determine is that increase or decrease an inflow or outflow. So I've said just use this formula. Opening minus closing, opening minus closing, and then this one closing minus opening. As simple as that. As simple as that. As simple as that. Juma, I've said the computation of this, we are using the same concept. If you have understood how we have computed the tax paid in the previous question, we are using the same concept. You see, the proposed dividends are the dividends, the proposed dividend are the current liabilities. Those are the dividends which were not paid at the start and also at the end. The proposed dividends we have in note number 5 are the dividends the company was supposed to pay during the current year. So how do you compute the actual dividends which were paid during the current year? You take the dividends the company was supposed to pay at the start, add what the company was supposed to pay during the current year, and then compare that with the dividends not yet paid at the end. Automatically, the difference represents the dividends which were paid during the current year. And that is basically the same concept used in the computation of tax, in the computation of interest. That's that? Yes, the same concept. If you understand that, that will save you for 3 items: the tax paid, interest paid, and the proposed dividend. That's that? Yes. So let's deal with these 3 items. We are going to go to where we have the statement of financial position, and we start by picking receivables. So not receivable, rather, let's start with the inventory. We take opening minus closing. The opening is the figure we have in the statement of financial position for 2022. That is 200 minus closing 40, 300. And I'm getting negative 81. Negative 81. I hope that is what you're getting. That is for inventory, not receivables. Inventory. Inventory here. Yes. So I'll do the same. We need to do the same for receivables. For receivables, we take the opening, which is 46,800 minus closing, which is 36,840. What are you getting? I'm given by Evans 9960, basically, which is a positive, is a cash inflow. Then we have said you also need to check whether you have other receivables or prepayment. Do we have other receivables or prepayment? No. We go down there where we have the current liabilities. Under the current liabilities, we only consider one item, account payable. Account payable, we use this formula, closing minus opening. Closing minus opening. So the closing is 35,100 minus opening, which is 31,500. And basically that will give us what? That will give us 36, which is a positive. Which is what? A positive, which is a positive. And then from there, we proceed and determine two other items. We proceed and determine two other items. One, we less the tax paid, and then we also less the interest or the finance costs paid. So we can start with the tax. Tax, we are using the same concept we have used in the other question. So we go to the income statement, how much is the tax for the current year, and the statement of financial position at the current liabilities. So can we first of all go to where we have current liabilities in our statement of financial position, and we consider whether we have tax. Yes, and we have tax. The tax which was not yet paid at the start is 36. And then to this, we add the tax in the income statement. I hope you can see the tax in the income statement, 54. And then we minus, just the way we have computed the dividends which were paid, using the same concept, minus the tax not yet paid at the end, which is 4920. So the tax in the income statement is 54. Tax at the start is this one. Yes, so that will give us tax paid of how much? Yes, 48. So we do the same for interest. For interest, you just need to go to where we have current liabilities. You check, do we have any accrued interest under the current liabilities? No. If that is the case, it basically means that the interest paid is what we have in the income statement here. But if we had any accrued interest under the current liabilities, we use the same concept. Take accrued interest at the start plus the interest or the finance cost from the income statement minus the accrued interest at the end, which will give us what? That amount. We are done there. So don't even bother yourself adding anything. Let's come here. I think here majorly we have dealt with most of the items because we are given the asset which were acquired, the asset which were purchased. Can we go to the equity and non-current liabilities in our statement of financial position? At the equity, first of all, I can see share capital. The share capital at the start was 90,000. It increased all the way to 108. What causes the share capital to increase? The share capital increases because our company issued shares. So we will come here and we say that there were shares which were issued. The shares which were issued will automatically be equal to the increase. 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 How much is the increase here? The increase is 18,000. So the shares which were issued by our company, they had a value of 18,000. 18,000, which is a cash inflow. Below that, what do we have? We have share premium. Share premium, did it increase? Yes. What causes the share premium to increase? The share premium basically increases because these shares which were issued, they were issued at a premium. That increase in the share premium represents the money which was received by the company in form of share premium. So you will also come here and you say there was increase in what? In share premium. And basically in this case, the share premium increased with how much? The share premium increased with 45. That also represents money which was received by the company, but in form of what? In form of premium. In form of premium. We are done with that. So below that, we have revaluation reserve. Do we consider that here? No. Revaluation reserve, this changes as a result of revaluation of assets. Once the company revalue assets, either upward or downwards, that is a non-cash item. We don't consider that here. Below that, the retained earnings, mostly that is used in the computation of dividends which were paid, but I think you already have that. Then we go to where we have 10% loan. 10% loan at the start, 32. At the end, that loan reduced. What causes a reduction in the value for the loan? What will make the loan to reduce from 34 million to 25 million? What causes the loan to reduce? What causes the loan to reduce? Who can tell us here? What causes the loan to reduce? The loan will reduce because of repayment. The loan reduces because of repayment. So we come here and we say there was repayment. There was repayment of 10% loan. There was a repayment of 10% what? Loan. So how much was the repayment, which is basically equal to the decrease? Which is equal to the decrease? Which is equal to the decrease? Is it 9? Is it 9,000? Is it 9,000? Yes. And automatically, the moment the company repays a loan, that involves what? Cash outflow. So if you have taken a loan from the bank, you repay back that loan. That involves cash what? Outflow. That involves cash outflow. That question you debate at that point. Don't even bother yourself adding the totals here. Don't. That is pure wastage of time. The person who is marking your paper will come and check these entries. Will come and check these what? These entries. These entries. These entries. These are the entries basically which will earn you marks. These are the entries which will earn you what? Will earn you marks. And I hope you can see in our case, have we done any working here? Have we done any working? No. You can see all the workings which we are doing. We are doing them inside the bracket here. That will save you a lot of time. Will save you a lot of time. By using this particular approach, number one, I've said you'll be able to finish the question within the time you have, because I've said for you to handle this question, never make a mistake of taking more than 40 minutes. Maybe these questions computation, you can give yourself 40 minutes, because most will come across a theory question. Maybe the time you're taking to do a theory question, maybe you can just reduce it, maybe like to 20 minutes, such that this computation don't take more than 40 minutes. If you take more than 40 minutes, then that is a disaster. That is what? A disaster, because you'll not be having time to handle the other questions. So just pick those low-hanging fruits, those 3 marks, which basically you can be able to get without a lot of struggle, without so many workings. And actually, you can see this question, even if, for example, this is how the question was marked, any 14 ticks at 1, you will see we already have all the 14 marks. All the 14 what? Marks. Because even if you count the number of ticks, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. So we already have all the marks with us. Yes. So that approach, which I've showed you, very, very important. So as you practice, so can you use that approach? Make use of that particular word approach. Basically, this will help you in terms of passing any question for cash flow. The other thing you also need to understand is where do you get 3 marks? Or basically what in other terms we refer to as low-hanging fruits. I've said there are those marks which are free. Like here, changes in working capital. Make sure you get those marks. Provided you can be able to remember it, and these formulas I've given there. Opening minus closing. Opening minus closing. Payable, closing minus opening. Then here you can be able to remember this acronym, dial G. Then here you also need to remember that the items we consider here come from equity and current what? Liability. So if you're able to do that, these are questions. Once you come across this question, be assured you'll be able to pass. And basically, like for those who are doing a CPA foundation level, so I'm expecting that this is one of the questions you're likely to come across. This is one of the questions I'm expecting it will be examined. It will be what? Examined. If you check last teaching, there was no question on this. So can you do a lot of practice? Can you do a lot of practice? A lot of what? Practice as far as that is concerned. And then there was that other part, part B, comment on how Biashara Limited has generated and used its cash from cash and cash equivalent for the year. Now, basically, for you to be able to do to make that comment, you have to get these net cash flows. For example, you get the net cash flows from operating, the net cash flow from investing, and then the net cash flow from what? Financing. You must get those particular net amount. So once you get those net amount, then you need to make a general comment. If, for example, here you get a positive figure, here you get a negative figure, and here you get maybe also a positive figure, the first thing you say is that this company generated cash, one, from operating activities because we have a positive there, and also from investing, from financing activities because we have a positive amount there. And then you say, much of the cash generated by the company was spent or was utilized by the investing activities because here we have what? We have a negative. We have what? A negative. Other than making that comment that the company generated cash through operating and financing activities, and the company spent cash through investing activities, you can then be more specific and you say that much of the money which was spent by the company, or maybe much of the money which was generated by the company from investing, from financing activities, it was generated from the issue of shares, because you can see here the company was able to raise a lot of money from the issue of shares. And here you can also be able to say that the company generated a lot of cash from investing activities by selling assets. By selling what? By selling assets. That is the comment. That is basically what you are expected to comment on. First of all, you must get the net cash flows from the three activities, and then make a general comment on which activities generated cash, which activities utilized the cash, and then you can also be more specific. You can be more what? More specific. More what? Specific. But what I want you to understand is basically how to handle this question for cash flows, particularly in what? In an exam. In an exam, because majority of the students basically understand how to prepare statement for cash flow, but basically they lack that particular knowledge of doing these particular questions in an exam. Because remember, you don't have all the time with you. You have just 40 minutes, less than 40 minutes to do what? To handle this question. You must be having a strategy on how to do the question within 40 minutes, and also how to get those 3 marks. That is very, very important. Very, very what? Important. Yes, so I'm told in this case, in case someone leaves a big space in between the 3 headings, will it be no? Basically, no. That will not have any problem. But basically, by then, by the end of the day, once you do a lot of practice, you should be able to know the space to leave here. So once you do a number of questions, you'll be able to see the space you need to leave here. Because I don't think you should leave more than half a page. More than half a page. More than half a page. Yes, more than half a page. Or maybe a 3/4, more than 3/4 of the page. Because this basically where we have so many items, as you can see in the 2 questions we have done. Yes. So what I want you to do, I want you to pick other questions, maybe from the past papers. Those who are doing FR, we have so many questions on this from your papers. Those who are doing FA, foundation level, so many questions on this. Also, those maybe who are doing AFR, this is also a knowledge you need to have. Even if now the question for AFR, they have additional concept. The aspect of acquisition of subsidiary, disposal of what? Of subsidiary, and so on. But this knowledge is basically important to all. The shortcut, how to get those row hanging what? Row hanging, or those basically those particular free marks. Yes. So basically for today, I want us to stop at that particular point. I want us to stop whereby the parent company has invested in an associate, or basically the parent company has invested in a joint venture. So the first thing we need to ask ourselves here is what is an associate, and also what is a joint venture. So maybe you can start by defining what is an associate. What is an associate? And basically in this case, an associate, we say that this is an entity in which the parent company exercises something called the significant influence. So this is an entity, where the parent company, I hope you can also be able to recall that the parent company is called the investor company. The parent company or the investor company exercises something called significant influence. So when we talk about the parent company exercising significant influence, this basically means that the parent company is not in a position to control the operating and financial decisions made by the associate, or even to control its composition of the board of directors. But the parent company is able to influence the operating and financial decisions which will be made by the associate company. Now, a parent company or basically an investor company is said to exercise significant influence over the associate if the parent company has acquired shares, which lies between 20% to 49%. If, for example, in this case, we are told 𝐻𝐿imited acquired shares which lies between 20% to 49% of the shares issued by 𝐉𝐿imited, it basically means that this company here will be able to influence the operating and financial decisions made by 𝐉𝐿imited. So this company is not able to control the operating and financial decisions of this, but it is purely able to influence. It is able to influence. So therefore, anytime you're given a question and you're told the investor company or the parent company acquired shares, which lies between 20% to 49%, it automatically means that the investee company, this company here, is an associate. Is what? An associate. So that is basically the definition of an associate. And then from there we have the other entities here, and basically that is a joint venture. Joint venture. So when we talk about a joint venture, this is an entity in which the parent company and another entity acquire something called a joint control. So this is an entity where the parent company, and another entity acquires joint control. Acquires joint control. So in this case, when we talk about the parent company and the other entity acquiring a joint control, it basically means that assuming we have two companies, 𝐻𝐿imited and basically 𝐵𝐿imited, so this company may enter into an agreement to acquire equal shareholding or to acquire equal shares in maybe a company which is called 𝐶𝐿imited. So this company acquired 50% of the shares. The remaining 50% of the shares are acquired by 𝐵𝐿imited. So in this case, we say that these two companies have acquired a joint control in C. Joint control means that the operating and financial decisions of this company here, that is C, will be jointly controlled by A and B. So A and B will be jointly controlling the operating and financial decisions which are made by C. And therefore, this company here, we refer to this company as a joint venture. We refer to this particular company as what? As a joint venture. Now, having known what is an associate and basically what is a joint venture, the other thing we need to ask ourselves here, how does the parent company prepare the group account whereby the parent company has invested in an associate or invested in a joint venture? Now, the preparation of group account in this case is governed by this particular standard, which is International Accounting Standard number 28. And this particular standard requires that whenever the parent company has invested in an associate or basically invested in a joint venture, the group account, the consolidated financial statement should be prepared using the equity method. So the group account in this case, we can say a group account, all the consolidated financial statements should be prepared using the equity method. So equity method basically is a method of accounting, and this particular method, how is it applicable in preparation of the consolidated income statement? How is it applicable in the preparation of the consolidated statement of profit or loss? So first of all, I want us we look on how this method is applicable when it comes to the preparation of the consolidated statement of profit or loss. So how do we apply this method? Now, number one, when the parent company has invested in an associate or basically a joint venture, and we are preparing this, we are saying we should be able to do that in accordance with the equity method. Now, this method requires one, when preparing this, similar items of revenue and expenses, those of the parent company and those of the associate, or those of the joint venture should not be consolidated, should not be combined. Should not be what? Should not be combined. So if the parent company has invested in an associate, has invested in a joint venture, you are preparing this, the consolidated statement of profit or loss. We are saying use equity method. And actually, according to the equity method, we are saying don't consolidate. Don't consolidate similar items of revenue and expenses, those of the parent and those of the joint venture, like what we are doing in case of an investment in a subsidiary. We said in our previous discussion, once the parent company has invested in a subsidiary and you are preparing this, you should combine similar items of revenue and expenses, those of the parent and those of the subsidiary. But in this case, we are saying we don't do that. So instead, what we include here, as far as the associate or joint venture is concerned, is the group share. The group share, loss associate, or basically joint venture, profit after tax, and other comprehensive incomes. Another comprehensive income. So what we need to do basically is to determine what is the parent company share of the profit after tax, and also the other comprehensive incomes, which were reported by the associate and also the joint venture, and then we include them within the consolidated statement of profit or loss. But in this case, we are saying never make a mistake of consolidating revenue and expenses, those of the parent, those of the associate, or those of the joint venture. Instead, what we include here is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Then from there, let's look on how this method is applicable when it comes to the preparation of the consolidated statement of financial position. Consolidated statement of financial position. Consolidated statement of financial position. Now, first of all, recall what we said in our previous class. Anytime the parent company has acquired a subsidiary and you're required to prepare this one, consolidated statement of financial position, we said you combine, you add together similar items of assets and liabilities, those of the parent, those of the subsidiary. Is that what we do here? No. So according to the equity method, when preparing the consolidated statement of financial position and the parent company has invested in an associate or basically a joint venture, we don't combine similar items of assets and liabilities, those of the parent and those of the parent and those of the associate or those of the joint venture. So in this case, we can say similar items of assets and liabilities, those of the parent company and those of the associate or those of the joint venture, they are not consolidated. Not consolidated means that they should not be combined. They should not be combined. Like what we are doing in case of an investment in a subsidiary. Here we don't combine. Instead, what do we include here? What do we include in the consolidated statement of financial position as far as the associate or the joint venture is concerned? We include something called the investment in associate, or basically investment in what? In the joint venture. So we have to compute something called the investment in associate, or basically investment in what? Joint venture. And actually we include that, we recognize that as a component of non-current asset in the consolidated statement of financial position. So how do we compute this one? To compute the investment in associate or the investment in joint venture, we start with the cost of investment. So the cost of investment, basically, this is a purchase consideration which was paid by the parent company in acquiring the shares of the associate, or basically acquiring the shares of the joint venture. So how much purchase consideration was paid? And then to this we add the group share of post acquisition retained earnings, post-acquisition retained earnings, and any other post-acquisition reserve. And any other post-acquisition reserve. Any other post-acquisition reserve. So when we talk about the post-acquisition retained earnings, post-acquisition reserve, this refers to any reserve of the of the associate, or basically the joint venture, after it was acquired. So the retained earnings of the associate of the joint venture after it was acquired, or any other reserve of the associate or joint venture after it was acquired, or which must be a post-acquisition, So compute the group share of that. And then to this, you less impairment loss. In most of these particular questions, you'll be told that the investment in associate or the investment in joint venture had impaired with a certain value. When talk about impairment of investment, this whereby you can invest your money in the company, but that investment loses value. You invested maybe by buying shares having a value of 200,000, but because the company where you invested has been making losses, it has not been able to pay dividends, your investment has reduced in value. The value of the shares you bought has lost some value. So that loss of value of the investment which you made in a company is called an impairment loss. The same case, the parent company may have invested in an associate or joint venture which has been making losses, and therefore you can be told the amount invested in the associate or the joint venture has lost some value. That is called an impairment loss, and basically we should deduct it here. Whatever we get here is basically what is known as the investment in what? In associate, or basically investment in joint venture, and basically this is the only item which is basically recognized. The only item which is recognized in the consolidated statement of financial position as far as the associate or the joint venture is concerned. We don't combine similar items of assets and liabilities, those of the parent and those of the associate, or basically those of the joint venture. Yes. So therefore, basically that's what you need to know. But if you can be able to recall what I said, is that most of the questions you will come across in the past papers, you'll be given three companies. You'll be given the parent company. You're told the parent company acquired a subsidiary, and also the parent company acquired an associate, or basically a joint venture. So you have three companies. Now you have to remember what we have discussed here. We have said in case the parent company has already acquired a subsidiary. So whenever we are preparing this consolidated statement of profit or loss, we combine similar items of revenue and expenses, those of the parent plus those of the subsidiary, those of the parent plus those of the subsidiary. In this case, I've said we don't include the revenue and expenses of the associate here, So we don't consolidate the revenue and expenses, those of the parent and those of the associate, or those of the joint venture. So you only combine for these two companies. So the same case, when preparing this consolidated statement of financial position, you are not supposed to combine to consolidate similar items of assets and liabilities, those of the parent, those of the associate, or those of the joint venture. So you should only combine similar items of assets and liabilities, those of the parent and those of the subsidiary. So we have said what you include here, as far as this associate or joint venture is concerned, is this item. You have to compute this item: investment in associate, investment in joint venture. That's what you recognize here. So here, what you recognize as far as this company is concerned is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Income. So basically, that is it. That's what you need to know as far as this is basically concerned. And I think with that, we can look on a question. I want us to look on a question on this. We look on a question on this. And basically from there, we should be done. So what will be remaining is for us to be able to do more questions on this. I want us to start with basically a simple question here. can start with a simple question. So let's look on this question for August of 2023. Let's go to the question for August 2023. August 2023. So once you get the question, please confirm. August of 2023. And this is question number 3. That should be question number 3. 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 Yes, I hope you are there. I hope you have that question with you. Are you there? Yes, yes. So what are we told? What are we told here? So we are told that Pika Limited, a public limited entity, intend to expand its operation by acquiring investment in other entities. On 1st of November 2022, Pika Limited secured 75% equity interest in Shiba Limited under the following terms. Number one, you are told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. Number two, an issue of 3 ordinary shares of shillings 10 per value in Pika Limited for every 5 shares acquired in Shiba. The fair value of Pika Limited shares was shillings 13 at the date of acquisition. The share issue has not been recorded by Pika Limited. So, and then you're told on the same date, Pika Limited also acquired 30% equity shareholding in Amua, paying shillings 24 million in cash. So then we are told the following draft statement of financial position as at 30th of April 2023 relates to Pika Limited and Shiba Limited. So we're given the statement of financial position for the two companies, Pika and Shiba. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information, number 1 all the way to note number 6. And then what are we required to do here? We are required to prepare number 1 or part A to calculate the value of goodwill arising on acquisition of Shiba. From part B, determine the value of investment in Amua Limited as at 30th of April 2023. And part C, we are required to prepare the consolidated statement of financial position of Pika Group as at 30th of April 2023. So before we do that, before we answer our question here, the first thing we need to do, number 1, is basically to come up with a group structure. We said anytime you come up, you come across a question for group account, the first thing you need to do is to come up with a group structure. Then from there, we will go through the additional information. We see, are there some workings which are required? So therefore, let's first of all, we come up with a group structure. So basically working 1 here will be the group structure. The group structure. So which information do we have about this? We are given information about the group structure within paragraph 1. We go back to paragraph 1, you're told, Pika Limited, which is a public limited company, intend to expand its operation by entering intend to expand its operation by acquiring investment in other entities. So we are told on 1st of November 2022, Pika Limited secured 75% equity interest in the company which is called what? Shiba. So we are told this company which is called Pika Limited, we are told secured 75% equity interest in the company which is called 𝐻𝐍𝐋 Limited, and we are given the date of acquisition, which is 1st November 2022. Remember, this is now the date of acquisition, the DOA. So we are given the terms of acquisition. Those terms, these are the payments which were made. We are going to compute that when answering part A of our question. And then in the last, there is the last paragraph down there where we are told on the same date. I hope you can see that paragraph. We are told on the same date, that is basically this date, we are told 𝐻𝐿 Limited also acquired 30%. This company on the same date, 1st November 2022, it's also acquired 30% equity shareholding in a company which is called 𝐻𝐿 Limited. 𝐻𝐿 what? Limited are paying shillings 24 million cash. It basically means that this company here, 𝐻𝐿, this will be an associate because you can see the shares acquired lies between 20% to 49%. This is basically an associate. So, but this one, 𝐻𝐍𝐋, this one is automatically a subsidiary company, whereas now 𝐻𝐿 Limited will be our parent. So the company which should prepare the group account, we said is always the parent. The group account should be prepared by which company? The parent company. And basically now we have the date of acquisition. Even before you move to computing maybe what is required, we say it is also important for you to be able to identify two dates. The two dates, the date of acquisition, which is abbreviated as DOA, and the date of consolidation, the DOC. The DOC is the date we require to prepare the group account. So we can only be able to get this date in our requirement. When are we required to prepare the group account? Can we go to part C of that question? In part C of the question, we are required to prepare the consolidated statement of financial position on 30th of April 2023. So the date of acquisition here, you can see it is 1st November 2022. So what we need to determine here is, were these companies acquired in course of the current financial year? If you can be able to remember the question we did in our previous class, the question for 𝐻𝐍𝐋 and 𝐻𝐿, I hope you can be able to remember our subsidiary was acquired 5 years back. So, but in this case, you can see this subsidiary or these two companies look like they were acquired during the current year, because even year is ending April, the next year will start 1st May, that is 1st May. So it means that this year started on 1st of May, but 2022. So therefore, you can see this date of acquisition, it falls within the current year. So these two companies were acquired in course of the current year. So how many months do we have here? So we can literally count. We have November, December, January, February, March, April, because that year is ending on April. How many months are those? 1, 2, 3, 4, 5, 6. So it basically means that these two companies, that is 𝐻𝐍𝐋 and 𝐻𝐿, they were basically acquired 6 months to the end of the year. 6 months to the end of the year. And we say this is very, very important, specifically when preparing the consolidated statement of profit or loss. If, for example, in our question, though that is not a requirement, if you are preparing, we are required to prepare the consolidated statement of profit or loss. In this case, we said we take the revenue and expenses of this company, that is 𝐻𝐍𝐋, basically for 6 months from the date it was acquired. So we take the revenue and expenses of 𝐻𝐍𝐋 for just 6 months by basically apportioning its revenue and expenses on time basis, and then we combine with that of the parent. But in our case, we are not required to prepare the consolidated statement of profit or loss. So therefore, it is important to note that these two companies were acquired 6 months to the end of the year. Now, having that, I want us to go straight to the additional information we see. There are some workings we need to do before we even answer our question. So in Roman 1, let's go to Roman 1, we see what you are told. So in Roman 1, you are told at the date of acquisition, the fair value of 𝐻𝐍𝐋 Limited, which is basically our subsidiary here, of 𝐻𝐍𝐋 Limited net asset, approximated their carrying amount with an exemption of plant whose fair value exceeded its carrying amount by 10 million. So we said, if you see this, And we say this is something you'll come across in all questions for group account. The fair value adjustment, the fair value exercise, which we said is the devaluation of asset by the subsidiary company on the date of acquisition. So we said because the subsidiary company devalued the asset but never accounted for that, we said in preparation of group account, we make two adjustments, the revaluation adjustment and the depreciation adjustment. So we are told that the plant was valued and basically its fair value exceeded its carrying amount by 10 million. Then in the other paragraph, we are told the plant had a remaining useful life of 10 years at the date of acquisition, and then you're told the plant is being depreciated on straight-line basis. The plant is still carried at its carrying value in 𝐎𝐍𝐋 Limited financial statement. In other terms, it means that this company devalued the plant but never accounted for that. That's why it is still carried at carrying amount. In the last point of note 1, we are told no fair value adjustment was necessary on the acquisition of Amua. This company didn't devalue the asset. So in that case, what you're given in note 1 is something called the fair value adjustment or the fair value exercise, specifically by which company? By 𝐎𝐍𝐋 Limited. So in this case, we said we have to make two adjustments as far as this is concerned. The first adjustment, and this is exactly the same thing we did in the other question. The first adjustment is called revaluation adjustment. And actually, we said this is an adjustment which is made in relation to the revaluation gain or loss. So if you check on the information which are given in paragraph 1, this company 𝐎𝐍𝐋 did fair value adjustment. The net asset, the fair value of the net asset approximated the carrying amount with an exception of an item of plant whose fair value, that is what is important, whose fair value exceeded, the fair value was exceeded or was more than carrying amount. The carrying amount we said is also known as the net book value with 10 million. But if you check our figures up there in our statement of financial position, our figures will be able to see them in thousands of shillings. We must also be consistent. We are going to work with all our figures in thousands of shillings. So this of the fair value of the plant was more than the carrying amount with 10,000 or with 10 million. So this one automatically is a revaluation gain. We said anytime the fair value exceeds the carrying amount is the revaluation gain. And because this revaluation gain was not accounted for by this company, we said this one will be added to the group PPE. This one should be added to the group PPE. And number 2, we said that this 10,000 is a pre-acquisition revaluation reserve. When computing the goodwill on acquisition of 𝐎𝐍𝐋, this will be one of the pre-acquisition reserve we are going to use. So number 2, we make the other adjustment, which is called the depreciation adjustment. Depreciation adjustment. In this case, we said we compute something called the depreciation adder charge. The depreciation adder charge, and that is depreciation adder charge specifically by 𝐎𝐍𝐋 Limited. We compute depreciation adder charge by who? By 𝐎𝐍𝐋 Limited. I hope you can be able to recall the formula which we use here. We said we take what? The revaluation gain, the exact thing we did in our question, in the other question, the revaluation gain, we divide that with the remaining useful life, and then in this case, we multiply that with the proportion of time. Proportion of time, of which we said proportion of time is basically the time we have from the date of acquisition to the date of consolidation. And I hope you can be able to recall here, that from the date of acquisition to the date of consolidation, I hope you can be able to recall we have how many months? 6 months. So these two companies, or actually 𝐎𝐍𝐋 was acquired 6 months to the end of what? To the end of the year. So this formula is what you need to remember always, is what we use in computation of what? The depreciation adder charge. So therefore, to compute this depreciation adder charge, we take the revaluation gain, which is this one, 10,000. We divide that with the remaining useful price. So what is the remaining useful price of this plant as per the information we have in note number 1? As per the information we have in note number 1, we are told paragraph 2, the plant had a remaining useful price of how many years? Of 10 years. of 10 years. I hope you can be able to see that, of 10 years. So that is the remaining useful life. And then we multiply that with the proportion of time. The proportion of time here will be 6 all over 12. 6 all over 12. That's basically how we compute the depreciation under charge. If you take on what you have done in this question, whatever we did in the other question is just the same. It's just the same. And basically I've said that this is an adjustment you'll come across in all questions for group account. In all questions for group account, you'll be told the subsidiary company on the date it was acquired, it revalued the asset. You must be able to record the adjustment which you make as far as that is concerned. So this will give us what? This will give us 1,000. A half of that is 500. I hope you're getting 500. So this 500 will be adjusted in which two items? One, this one will be deducted from the group PP in preparing a consolidated balance sheet. And then we also deduct it from the retained earnings of this company. The retained earnings of this what? Company. Now, if in this question also we were preparing the consolidated statement of profit or loss, this one we said we added to the group cost of sales. But automatically this adjustment is not necessary simply because we are not preparing the consolidated statement of a profit or loss. So we will just add that, less that from the group PP, we less it from the retained earnings of who? Of Sheba. Of who? Sheba. So let's move to point number 2. In point number 2, we are told that on 28th April 2023, 28th April of 2023, this is basically some few days to the end of the year. So we are told Sheba Limited, which is this one, sent goods at an invoice price of 7 million to Pika Limited, which Pika Limited neither received nor recorded until 5th of May 2023. I hope you can be able to remember what is that. Automatically, that is now what we refer as the goods in transit. The goods in what? In transit. These are the goods which were sent by this company, but when the year was coming to an end, this company had not received nor recorded those goods. So we refer to them as goods in transit. The goods in transit. The goods in what? The goods in transit. Goods in transit, the GIT, the goods in what? In transit. Now, we said as far as these goods in transit are concerned, we make 3 adjustments. There are 3 adjustments which are made here. That is basically what you need to remember from our discussion. We said we make 3 adjustments. The first adjustment is basically to recognize the goods. To recognize what? The goods. That's the first thing you need to do. To recognize the goods. So these goods which were sent by this company, but when the year was coming to an end, this company had not received and accounted for them. So those particular goods, they had a value of 7 million. Even before we go to the last paragraph, to the next information which is given here, the goods had a value of 7,000,000. So how do we recognize these goods in the books of account of the parent? So if the parent company had received these goods, the parent company or these goods were supposed to be part of the inventory of the parent and part of the payables because the parent company had not paid for them. So therefore, these ones, we will add them to the group inventory. That is first adjustment. And then number 2, we add them to the group payables. So those are the 2 adjustments which will be made to recognize those goods. So if this company had received those goods, they were supposed to be part of the inventory and still part of the payables. Part of the payables. So then the other adjustment which we need to make is the adjustment for unreleased profit, because automatically this company made some profit, but automatically the entire profit was not yet realized. This company had not received those goods, so mean that the goods were not yet to be sold to the third parties. We make adjustment for unreleased, we compute the unreleased profit, and also these goods will give rise to amount of intercompany debt. But before we do that, we can go through the other information which are given in note number 2. Specifically the last sentence of paragraph 1, we are told 𝐍𝐿 Limited, which is basically the company which sold the goods, had marked up these goods at 25% on cost. And then you're told the last paragraph, the agreed trade payables record in the books of PICA, the agreed trade payables recorded in the books of PICA Limited before the above transaction of 6 million. Okay, so before we do that, let's first of all, we compute the unleased profit on these goods, unleased profit on the inventory. So the unleased profit on the inventory. So because we say that these goods were not yet received by this company, so mean that the profit which was made by 𝐍𝐿, this profit was not yet realized. So this unleased profit is by the selling company, which is 𝐍𝐿. So how do we compute this one? We take the goods in transit, we multiply that with the gross profit margin. So the goods in transit had a value of 7,000. That is the value of the goods in transit, this one, times the gross profit margin. Are we given the gross profit margin in that question? Are we given the gross profit margin? No. Whatever we are given is the gross profit markup. We are given gross profit markup as 25%. 25% as a fraction is 25% all over 100, which is basically a quarter. So if we have that as our markup, how do we compute the gross profit margin? We say this one will be equal to 1 all over 4, and then to this we add the numerator. So this one will be 1 all over 5. That is our margin. So our margin, therefore, here will be 1 all over 5. So give me the final figure here. The final figure here, which is 7,000 divided by 5. So that will give us an unleased profit of 1,400. So this unleased profit one will basically be deducted from the group inventory. And number 2, we also deduct this from the retained earnings of 𝐍𝐿. The retained earnings of 𝐍𝐿. So the other adjustments which we need to make as far as these goods are concerned is an adjustment for amount of intercompany debt. Remember, this company sold some goods, sent them to the parent, but basically, because this company had not received those goods, automatically it had not paid for them. So that gives rise to amount of intercompany debt. So the amount of intercompany debt automatically will be equal to 7 million. But now there is also another information which are given in note number 2, the last sentence. Can we go to note number 2, the last paragraph? We are told the agreed trade payables recorded in the books of PICA before the above transaction was 6 million. What does that mean? It basically means that before this transaction here, before this transaction of the goods in transit, there was another amount of intercompany debt of how much? Of 6 million. So by the end of the day, the amount of intercompany debt between 𝐍𝐿 and PICA will be equal to the 6 million plus this other amount of 7 million. So the total amount of intercompany debt by the end of the day will be what? Will be 6 million plus now this one, 7 million. This is the total amount of intercompany debt. So this total amount of intercompany debt, this one, 13 million. This one, recall the adjustment. This one will be deducted from the group receivables and also from the group what? Payables. And remember, this amount of intercompany debt is the same. So it will be deducted from the group receivables and also deducted from the group what? From the group payables. The amount of 13 million. The amount of 13 million. So having that, we need to move to the other point. So therefore, if you come across that adjustment or that item, the goods in transit, you have to recall those 3 adjustments. Recognize the goods, compute the amount of the nearest profit, also they give rise to amount of intercompany debt. So number 3, we are told, a PICA Limited policy is to measure the non-controlling interest at fair value on the date of acquisition. We said this information is to help you compute the goodwill. NCI is to be measured at fair value. When computing the goodwill on acquisition of the subsidiary, we use the full goodwill method. We are told for this purpose, the directors of Pika Limited consider Shiba Limited shares Shiba Limited share price of shillings 12 per share to be appropriate. In this case, we are not specifically given the NCI at fair value, but I'll be able to show you how we compute that specifically when answering part A of the question. So, but when computing the goodwill on acquisition of Shiba, we are going to use the full goodwill method. Then number 4, we are told impairment test performed on 30th of April 2024 at the end of the current year revealed that the goodwill on acquisition of Shiba Limited had not impaired. The goodwill on acquisition of Shiba had not impaired. We don't have any impairment loss. And then you're told, but due to the declining sales of Amua, which is the associate, the value of investment in Amua had been impaired to an extent of 2 million. So this is an impairment loss in relation to the investment made in Amua. So we are going to use that in answering part B. And then number 5, we are told Amua Limited reported profit after tax of 4 million during the current year. Also, that one will be used in answering part B. And then we are told number 6, assume all the profit and losses of the 3 companies accrued evenly throughout the year. So I think no workings which are required there. So what we need to do, we can go straight to answering part A of the question, basically whereby you are required to compute the goodwill on acquisition. The goodwill on acquisition of what? The goodwill on acquisition of Shiba Limited. Remember, in this case, I've said, as per the information which are given in note number 3, we are going to use the full goodwill method. We will use the full goodwill method because we are told the policy of the group is to measure NCI at fair value. We said if you come across that information, then compute the goodwill using the full goodwill method. So in this case, we need to have 2 columns. 2 columns here. So what do we start with here? We always start with the purchase consideration. The purchase consideration which was paid by the parent, company. And then to this, we will add the purchase consideration paid by the NCI. So the purchase consideration paid by the parent company, this information, we have it below paragraph 1. So let's go back to paragraph 1 of our question here. Paragraph 1. In paragraph 1, we are told Pika Limited, which is our parent, a public limited entity, intends to expand its operation by acquiring investment in other entities. In the last sentence, we are told on 1st April 2022, Pika Limited acquired or secured 75% equity interest in Shiba under the following terms. We are given the terms of acquisition. We are told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. So in this case, we are told when the parent company acquired 75% of Shiba, there was a cash consideration. The cash consideration, that immediate cash payment. Immediate cash payment, if you can be able to recall, we refer to that as what? As cash payment. And in this case, we are told the amount which was paid here is 13 shillings per share. 13 shillings per share. Now, you may decide to compute this. So basically, to compute that, we should take 13 shillings. 13 shillings, you multiply that with the shares acquired in Shiba. The shares acquired. The shares which were acquired. But there is no need of computing this because this value is given in the statement of financial position of Pika. Can we go to the statement of financial position of Pika? Specifically where we have the non-current assets. In the statement of financial position of Pika, under the non-current assets, we have PP, property, plant, and equipment. And then from there, we have investment in Shiba. Investment in Shiba, you can see we are given 6 million shares at shilling 16, at shilling 13. So meaning that the shares which Pika Limited acquired in Shiba were 6 million. was 6 million. So 6 million times the amount which was to be paid per share, which will give us what? Which will give us 48 million. 48 what? Million. So, and why are we told the shares acquired were 6 million? So we can first of all determine how many shares are issued by this company. The shares issued by 𝐍𝐋𝐈, you get that from the balance sheet of 𝐍𝐋𝐈 at the equity. At the equity, the share capital of this is 80,000. So for us to be able to know the shares issued by 𝐍𝐋𝐈, we will divide that with the par value. And I hope you can see the par value where we have the word ordinary shares in the balance sheet. The ordinary shares of this company, they have a par value of 10. So the shares issued by this company are 8,000. So the shares 𝐻𝐿 Limited acquired in 𝐍𝐋𝐈 was 75%. So if you get 75% of this, that basically will give you 6,000. Alan, what are you referring to, 70 or 48? Okay, so the price is okay. This one should be 78, not 48. Yes, so that one is okay. It should be 78. Yes. So therefore, the cash consideration here is 78. 78. So 13 shillings times the shares acquired. Then I want us to go back to the information we have below paragraph 1, because other than this cash consideration, in point number 2, we are told there was an issue of 3 ordinary shares of shillings 10 per value in 𝐻𝐿 Limited for every 5 shares which were acquired in 𝐍𝐋𝐈. If you can be able to recall, we refer to that as the share exchange consideration. The share exchange consideration. So for the share exchange consideration, you need first of all to remember the formula. How do we compute the share exchange consideration? The share exchange consideration. In this case, we say compute the number of shares which were issued by the parent. Issued by who? The parent company. So this one we said the examiner will not give you this one, and then multiply these shares with their fair value or market price on the date of acquisition. So this is something we are already given. In that point. In that point, we are told the last sentence of that point 2, we are told the share issue. Okay, not that point, but point number 2. There is one somewhere we are told the fair value of 𝐻𝐿 Limited shares was shillings 13 per share on the date of acquisition. So the shares of the parent company on the date of acquisition, they had a market price or a fair value of shillings 13. That one is already given. So what we need to do is to determine this. How many shares were issued by the parent company to pay the purchase consideration? We are going to use that information we have in point 2, where we are told an issue of 3 ordinary shares of shillings 10 in 𝐻𝐿. So 𝐻𝐿 here was to issue, 𝐻𝐿 Limited was to issue 3 shares for every 5 shares which were acquired. For every 5 shares which were acquired. So in our case, do we know how many shares were acquired by 𝐻𝐿 in 𝐍𝐋𝐈? Do we know how many shares 𝐍𝐋𝐈 Limited acquired in 𝐻𝐿? Sorry, how many shares 𝐻𝐿 Limited acquired in 𝐍𝐋𝐈? Do we know how many shares were acquired by our parent company, the subsidiary? Do we know how many shares were acquired by the parent company in the subsidiary? Do we know how many shares were acquired? Do we know how many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? We have already dealt with that somewhere here. Just now. Yes, we have said the shares which were acquired were 6 million. We have computed that here. We have said that this one was also computed based on 6,000 shares which were acquired. The shares which were acquired were 6,000. So what we just need to do is to cross multiply, then we divide. So therefore, the shares which were issued here will be because we need to cross multiply, then we divide 3 times 6,000 divided by 5. So this will give us 12, and basically that will give us what? That is 600. That is 600 shares. So these are the shares which were issued by the parent company. The parent company issued these shares. It issued, that is 600 shares, and then we need to multiply those shares with their fair value, which is shillings 13. So therefore, let's compute the share exchange consideration. That is 6 times 13. So I'm getting a figure of 46,800. Are you getting that figure? 46,800. 46,800, yes. So now, this is the purchase consideration paid by the parent. Then to this we say, when using the full gooding method, we add something called the NCI. The NCI at fair value. In other terms, if you can be able to recall, we said NCI at fair value. This refers to the purchase consideration paid by NCI. So when the minority shareholders acquired their shares, how much amount did they pay? Now, if we go back to the information we have in note number 3, we are not given this NCI at fair value. If you can remember the other question we did for Kuja 20, this value was given, the NCI at fair value. But if that NCI at fair value is not given, to compute that is quite simple, because we are saying when minority shareholders acquired their shares here, how much amount did they pay? So automatically you need to determine how many shares were acquired by the minority shareholders here. We know the parent company acquired 75% of the shares. The remaining 25% of the shares are the ones which were acquired by who? The minority shareholders. The minority shareholders acquired the remaining 25% of the shares. So therefore, we need to compute how many shares were acquired by the minority shareholders. 25% of the shares issued by this company. Hope you can remember, we have said that the shares issued by Shiba are 8,000. Its share capital divided by the par value. The shares issued by Shiba are 8,000. So these are the shares acquired by minority shareholders. So for us to be able to know the amount they paid for those shares, we have to multiply that with the market price of the shares on the date the shares were acquired. So automatically the shares were acquired on this date, the date of acquisition. Now, if you go back to point number 3, the last sentence, we are told for this purpose, the directors of Pika Limited considered Shiba Limited share price of shillings 12 per share to be appropriate. So it basically means that when the parent company acquired 75% of the shares, when the minority shareholders acquired 25% of the shares of these, each share had a market price of shillings what? Each share had a market price of shillings 12. So meaning that the amount of purchase consideration paid by minority shareholders was what? Was the shares they acquired, 25% of these times the market price per share. They paid shillings 12. They paid shillings what? 12. So therefore, in case you come across a question and you're not given the NCI fair value, what you do, compute the shares acquired by minority shareholders by NCI, multiply those shares with their market price on the date of acquisition. That will give you what? The purchase consideration which was paid. So this will give us 0.25 times 8,000, which basically 2,000. 2,000 times 12, which will give us what? 24,000. Yes. So in this case, we need to add all this, which is the purchase consideration paid by the parent and who? NCI. So we have 78 plus 46.8 plus 24. And this will give us 148,800. So that is the purchase consideration paid by both the parent and also who? NCI. And then to this, we proceed with less the fair value of net assets acquired. fair value of net assets acquired, fair value of net assets acquired. This is basically something we said the examiner will not have given you. So, but is you have to compute this. We said in this case we need to determine at the date this company was acquired, what was the fair value of its net asset? And actually we said we compute that by adding its ordinary share capital plus the pre-acquisition reserves, So therefore what we need to do here is basically to take the ordinary share capital of this company, that is of Sheba. Where do we get that? We get that at the equity section in the balance sheet of Sheba. So the ordinary share capital of this company is what? From its statement of financial position, it is 80,000. So below that, we don't have anything else, but basically what we have is the retained profit. So retained profit, or basically the retained earnings, this one, we need to compute the retained earnings of the date of it was acquired. Now, if you check on this question, there is nowhere we are told we are given the retained earnings of this company on the date it was acquired. So generally, this is something you need to know moving forward. Anytime a subsidiary company was acquired during the current year, there is no single time the examiner will give you its retained earnings on the date of acquisition. But if you can remember the other question which we did for Kuja Twende, which was acquired, a subsidiary was acquired 5 years back, we were given its retained earnings on the date of acquisition. So, but a subsidiary acquired during the current year, the examiner will not give you its retained earnings. In very rare cases, the examiner will give you that. So you have to compute. Basically, what we know, I hope you can be able to remember that this subsidiary was acquired 6 months to the end of the year. That's what we said. It was acquired 6 months to the end of the year and automatically 6 months from the start. So what we do for us to be able to compute, because what you're interested with is the retained earnings of Sheba on this date. It was acquired 6 months from the start of the year, 6 months to the end of the year. So if you go back to the information we have in the balance sheet, when you go to the balance sheet of Sheba, specifically at the equity, you can see we are given the retained earnings of Sheba at the start of the year. That is on 1st May 2022. 1st May 2022 is at the start. We are given the retained earnings of that company at the start of the year. The retained earnings of Sheba. Remember, you're interested with Sheba at the start of the year, here, which was 12,800. That is the retained earnings of Sheba at the start. And then we also given the profit for this year, the retained profit for this year for Sheba, which is 10,800. So the reason why you're given that information is for you to be able to compute the retained earnings of Sheba on this date here, this date. How do we compute the retained earnings on the date of acquisition? Very, very simple. We take the retained earnings at the start of the year, this one, which is 12,800. And then to this, we add the profit, which was the retained profit for this period, for these 6 months, because we're interested with the retained earnings of Sheba on that date. So how do we get the retained earnings for the first 6 months? So we will take the retained profit for the whole year, which we also given as 10,800, and then we apportion this on time basis. We multiply that with 6/12, so that we know the retained earnings for the first 6 months. So once we take this as the retained profit for 6 months, we will be able to get the retained earnings of Sheba on the date it was acquired, that date there. So this will give us 12,800 plus basically half of this, which is 5,400, and this will give us what? This will give us 18,200. 18,200. Are you getting 18,200? 18,200. Yes, that will give us 18,200. And basically that is the retained earnings of Sheba on the date it was acquired. So therefore, anytime a subsidiary was acquired during the current year, the examiner will not give you its retained earnings on the date of acquisition. You must compute that. So that is basically the only reserve which we have within the balance sheet of Sheba. Then from there is something we said you must always remember to check whether the subsidiary company revalued assets on the date of acquisition. If yes, was there a revaluation gain? And I hope you can be able to remember on the date Sheba Limited was acquired, it revalued an item of asset and there was a revaluation gain of 10,000, this one. So that one, we recognize it here. We recognize that there as a pre-acquisition what? Reserve. And basically, in our case, we don't have anything else. So what we need to do is basically to get this total. To get this total, so let's add all those figures. We have 18,200 plus 10 plus 80. This will give us 108, 200, 108, 200, 108, 200. And in this case, remember, we're interested with the goodwill of the parent and the goodwill of the NCI. So what we do here, we take the net asset acquired by the parent and the NCI. The net asset acquired by the parent and the NCI should be 100% of this. So 100% of this is 108, 200, which basically will be less from the figure we have up there. We take 100% of that. So we less that from 148, 800. And this will give us a figure of 46 what? 600. 4600. So this is what? This is the goodwill on acquisition. The goodwill on acquisition. And remember, the information which are given in note number 4, we are told that this goodwill is not impaired. The goodwill has not lost any what? Any value. So that is basically the amount we are going to take to, we are going to recognize in the statement of financial position as a non-current, asset. So this is what was required in part A of that question. And basically by doing this, the marks allocated here basically were 4 marks. So let's move to part B of that question. Part B. So in part B, what are we required to do? We are required to compute the value of investment in 𝐉𝐻𝐶 Limited. So this is part B, value of investment in 𝐉𝐻𝐶 Limited. In other terms, what we are required to compute here is something called the investment in associate. Remember, 𝐉𝐻𝐶 Limited is an associate. We are required to compute the investment in associate. So, and what we just need to recall is the format which I've just given you. How do we compute the investment in an associate? I've said we take the cost of investment, or the purchase consideration, and then to this we have said we add the group share of post-acquisition retained earnings, and any other reserve. And I think in this case, this associate do not have any other reserve other than the retained earnings. And then to this we less what? Any impairment loss. Loss. This one is quite simple because everything is provided here. I think we can start with the impairment loss, this one, which is given in note number 4. In note number 4, we are told that impairment test performed at the end of the year revealed that the goodwill on acquisition of Sheba was not impaired. This one had not impaired, but due to declining sales of 𝐉𝐻𝐶, the value of investment in 𝐉𝐻𝐶 was impaired by 2 million. So we have an impairment loss here of 2 million, which basically we realize here. So what about this one? So we know that this associate was acquired 6 months to the end of the year. So if we go to note number 5, we are told 𝐉𝐻𝐶 Limited reported a profit after tax, which is the same with the retained profit of 4 million for the year. During the current year, this company reported a profit of 4 million. And taking into account it was acquired 6 months to the end of the year, we want to know how much profit will the parent company be entitled to share. We will take the profit for the whole year, 4 million. But in our case, we're interested with the profit from the date 𝐉𝐻𝐶 was acquired. 𝐉𝐻𝐶 was acquired 6 months to the end of the year. So we compute the profit after 𝐉𝐻𝐶 was acquired, and that is what we refer to as the post-acquisition retained earnings, which will be 6 months to the end of the year. We multiply that with 6 over 12. We get the profit for the last 6 months, and then we get the parent company share of that. The parent company share of that will be equal to 30%. Will be equal to 30%. So let's work out that, which is basically quite simple. Half, which is 2,000, we multiply that times 0.3. And that will give us what? That will give us 600. That will give us 600. Then this one is given. This one is given. So we go to the balance sheet of the parent and the assets. How much amount did the parent company invested in 𝐉𝐻? So that is given in the balance sheet of PICA under the non-current assets. The amount invested in 𝐉𝐻 is 24,000. 24,000. So you can see this one was quite simple because almost everything was given. So we compute now the investment in associate. 24 million plus 600 minus 2,000. So that will give us 22,600. I hope that is what you're getting. I hope that is what you're getting, yes. And basically by doing that, equally the marks allocated there are 4. So let's move to the last part of the question, whereby we are required to prepare the consolidated statement of financial position, basically for the year, which ended 30th of April 2023. 30th of April 2023. 30th of April 2023. 30th of April 2023. So Aaron, you're asking about what? How did you get 20,000 revaluation gain on part? Where do you have revaluation gain, Aaron? Do you have a revaluation gain somewhere of 20,000? I can't see that. I can't see any revaluation gain of 20,000. I can't see a revaluation gain of 20,000. So maybe retype your question again. Retype your question again of 10,000. This is what we dealt with here, Aaron. Take what we did in working one. And basically, can you try to see what we did in the other question? If you can be able to recall what we did in the other question, we are doing the same thing here. We are doing the same thing. So try to understand those concepts which are in all questions, especially this one. This one, you must understand this. This is in all questions for group account, fair value adjustment. So let's prepare this one. And basically, how do we prepare this? I want us to do this in the next 20 minutes. How do we prepare this one? We prepare this basically by combining similar items of assets and liabilities, those of the parent, those of the subsidiary. And that's why in this case, for example, you can see even the examiner has not given you the asset and liabilities of who? Of associate, because we don't consolidate an associate. What we include here as far as the associate is concerned is what we have computed here. Yes, so we only add assets and liabilities of the parent, those of the subsidiary. The other thing which is also important for you to note is that even if this subsidiary was acquired 6 months to the end of the year, we don't do what? We don't apportion assets and liabilities on time basis. So apportionment only applies to revenue and expenses. So we have to take the full amount of assets and liabilities of the subsidiary, even if it was acquired 6 months to the end of what? Of the year. So let's do that. So here, we will start with the non-current assets. So I will take the PPE and basically take the PPE of the parent, 135, plus the PPE of the subsidiary, 100, 400. And then to this, we need to check, do we have any adjustment affecting the PPE? Yes, this working one. This revaluation gain, we said we added to the PPE. And then number 2, we have this depreciation under charge of 500, which we said we left from the PPE. So 2 adjustments here. We add 10,000 the revaluation gain, and then we less what? We less 500. No any other adjustments. No any other adjustment. We get the final figure. We have 135 plus 100, 400 plus 10 minus 500. And I'm getting 244, 900. 244, 900. So below that, please confirm whether you're getting the same figure. So below that, we have investment in Shiba, investment in Amua. Do we include those items here? The purchase consideration paid in acquiring shares of Shiba? No. Instead, the investment in Shiba has been used in the computation of this goodwill. So what we include here in relation to Shiba is the goodwill on acquisition of Shiba Limited. How much is that? 4,600. That is basically what we include here. In relation to Amua, we include what we have computed here. The investment in Amua. The investment in Amua, what we have computed here, 22,600. That's basically what we include here. And I think in our case, we are done with the non-current assets. So we need to proceed and basically record the current assets. So for the current asset, I will start with the inventory. So for the inventory, I will take for the two companies, I combine them, and then I make the necessary consolidation adjustment. 28,400 plus 12,100. And we said we have a number of adjustments affecting that. One, we have this goods in transit. Goods in transit. We said this 7,000 will be added to the group inventory. And then we have this unreleased profit over 14, which we said we also left from the group inventory. So two adjustments to be made here. So we add 7,000, the goods in transit, this one, and then we do what? We left this unreleased profit of 14. 46,100. Okay. So below that we have what? We have the trade receivables. We have the trade receivables. The trade receivables, I'll do the same. I'll take the trade receivables of the two companies, I combine them, 27,500 plus 19,900. And then I check, do we have any adjustment here? Yes. We have this adjustment for amount of intercompany debt, 13, which will be deducted from this group receivables. I only have this adjustment here. That no any other adjustments. So we get the final figure, 27,500 plus 19,900 minus 13. So which will give us 34,400. So then finally we have the cash and cash equivalents. So we add for those two, for the two companies, that is basically 10,600 plus 68 plus 68. Do we have any adjustment affecting this? No, because we don't have any cash in transit. We just need to get the total. So that will give us 17,400. 17,400. And then what do we need to do? We need to get the total assets. So the total assets, we add all this. We have 17,400 plus 34,400 plus 46,100 plus 22,600 plus 46 plus 244.9. So in this case, I'm getting 406. I'm getting 406. 406. 406. 406,000. 46,000. 46,000. I don't know whether you're getting the same. So I can do away with this to create space here. Yes, someone to confirm whether you're getting the same. Yes, that is confirmed by Juliet. Okay, so then from there we proceed and record equity. So that is share capital and reserves. So at the equity, we will start with the ordinary share capital. Ordinary share capital. In this case, we said for the ordinary share capital, we record that of the parent company only. The ordinary share capital of the parent, in this case, will be 160,000. But in this question, the ordinary share capital of the parent will be having an adjustment. We said whenever the parent company has paid some purchase consideration by issuing shares, those shares which were issued by the parent company, they were not accounted for. And basically, we said the shares issued will affect the ordinary share capital and the share premium. So, and how many shares were issued by the parent company, the payment of purchase consideration? We computed those shares. In our computation of the purchase consideration, did we say the parent company issued, were they that 600? Because the parent company was to issue 3 shares for every 5 shares acquired. The shares acquired was 6,000. I think we multiplied this. So this was 3 times 6,000 divided by 5. And I think this was coming to 36. Yes. The shares issued by the parent were 36. Now, what do we add here to the share capital? The amount we add to the share capital is an amount equal to the par value. So the par value of these shares, would be 36 times the par value per share, which is 10. So that will increase this. So this will be 36,000 times this, which will give us 196. And when the parent company issued these shares, what was the market price per share? Ile market price tumetumia ku compute purchase consideration. Was it, it was 13, Was it 13 shillings? 13. So the amount which is above 10, and basically that is 3 shillings, that is a share premium. So belonging to the parent. So in relation to these shares which were issued by the parent, tutakuwa na share premium ya 36 times what? Times 3 shillings. Times 3 shillings. Times 3 shillings. That will give us what? That will give us what? That will give us then 800. That will give us then what? 10,800 is the share premium of the parent. Yes. So then from there, there is something we said which must be computed here, which we said this is one of the items which is quite demanding, and that is the retained earnings. And I think moving forward, there are those items. In fact, because we said even in an exam setup, these are items you don't need to compute. Like this one, the retained earnings, because we said by doing this, it's not a must you have to get everything correct. Yes. So maybe first of all, you can skip this. If you're going to have some time, we will compute. But this is an item I'll not advise you, even in an exam, never bother yourself computing this. The other item we also need to compute and we include here is basically something called the non-controlling interest. Also, we will compute that if time. But let's first of all proceed and record the liabilities. We will be able to compute that. So these are 2 items which are quite demanding. So the non-current liabilities, I will start with there are actually 2. We have 10% bank loan. 10% bank loan. No adjustment for this. We just add that of the parent and that of the subsidiary. This will give us 35,000. No adjustments there. Below that, we have deferred tax. We said anytime you come across a component for tax, also this is a pre-mark. No adjustment. We just add 37 plus what? Plus 31, which will give us 68. No adjustments here. Then we go to the current liabilities. For the current liabilities, we will start with the trade payables. Trade payables, we add that of the parent, 28,800, plus that of the subsidiary, which is 21,200. And then now to this, we have, I think, 2 adjustments affecting the payables. One, we have these goods in transit. This amount of 7,000, we said we added to the payables. So to the payables, we add 7,000. And then I hope you can also be able to recall we have this amount of intercompany debt, 13. So to be deducted from payables. So we also less 13,000. So those are the only items, the 2 items to be adjusted to the payables, So let's get the final figure here. which is 28,800 plus 21,200 plus 7,000 minus 13. So I'm getting 44,000. 44,000 like that. 44,000 like that. And then finally, I have current tax. Current tax, we said, being a component of tax, this is also another 3 months. So you have 19 plus what? Plus 13. Plus 13. This is also a 3 month. And basically, this will give us what? This will give us 32. This will give us what? 32. This will give us 32. Then we will get the total equity and what? The total equity and liabilities. The total equity and what? And liabilities. The total equity and liabilities. Do we need to compute these two items or we can just leave them? Do we need to compute them or we can just leave them? Because like this question, by doing that, we'll be able to get all the marks even without necessarily coming back to compute these two items. I hope you can be able to recall the other question which we did, the computation of these two items. We said we were able to see that it is basically quite demanding. But basically, once we're able to do this, you'll be in a position to score all the marks. You'll be in a position to score all what? The marks. You can see the marks allocated there are 12. In most of the cases, this is how the marks are allocated. For every 6 correct entries, you are given 2 marks. You're given 2 what? 2 marks. For every correct entry, here you get how many marks? You get 2. You get 2. It basically means that it's not a must. You have to get everything correct. Everything good? Correct. Sasa? Yes. So easy 2 items. I think we can just leave them. No need of computing them. You'll be able to see that even during our revision, kuna zile vitu tutakuwa tuna compute. Naambia kwa mtihani na this one, you don't need to compute that. It will basically consume a lot of your time, and you don't have to compute some of those items for you to be able to get all what? All the marks. All what? The marks. Now, I want us to stop at that point for today. I want you to have a short break before you start the other class. We stopped at that point for today. There are so many questions from the past papers. I want us to do another one question in our next class. Then after doing that, we will wind up with this topic, but we will be able to come back to this topic during our revision because there are like 2 topics, not big topic. We have a topic on borrowing cost. Will just take us 1 class, and a topic on conversion of partnership into a limited liability company. I think majorly those are like the computation topics which are remaining. Before now, we start our revision and we look on some theory topics which are remaining. So right now, I said we are almost 90% done with the syllabus. 90% done. I'm hoping that actually by next week, because on Tuesday we will be able to do 1 question on this. We will be able to see whether we can be able to do 2. If we can be able to do 2, that will be very good for us. We see whether we can be able to do 2 questions. We wind up with this, and then from there, our next class on Thursday, God willing, we should be able to do borrowing costs, and then we start on. I think let's start with the conversion of partnership on Thursday, which we should be able to finish on Saturday, and it basically means that by the other week, we will be having, I think, 1 computation topic, which will be remaining. Though there are other theory topics which will be remaining, which I think we will be able to create time and basically go through them. So therefore, I'm saying right now, I think we are over 90% done with the syllabus. Remember what we agreed by 21st, we should be able to embark on revision. We should be able to embark on what? On revision. Sasa? Yes. So maybe you can check on the question which was there sitting or any other question. We will pick a question having 3 companies, parent, associate, and also a joint venture, or basically that is parent, associate, or joint venture and a subsidiary, and basically a question requiring the preparation of consolidated statement of profit or loss and the consolidated statement of financial position, so that we finish on this work. on this topic. So let's stop at that point for today. We continue from there in our next class. So we can see you next week.